Good evening, everybody.
Good evening.
How's everyone doing tonight?
Hi, everyone.
We are unbelievably excited. There's everyone's video popping up. We're unbelievably
Yeah.
excited to be here. We did not expect this to be the case, but we have actually already, been fully committed for Nicholas and Oliver, and we are we're just making up kind of the remaining difference. We can kind of see, commits coming in real time in the portal. Everyone's welcome to go to blackswanfund1.com right now if they want to commit at any time in our webinar today. As we go through, we're gonna collect questions. We've got a couple producers here with us, Rebecca and Riley and Stephanie, and they're gonna capture notes in a little Google Doc to make sure we get to as many questions as we can at the end. I suspect this webinar could run long, so we want to get through our content as quickly as we can at the beginning, and then we'll stick around as long as we can to answer as many questions as we can. But we are unbelievably excited about this opportunity. I think this is probably like the most exciting opportunity we've ever had, and can't wait to tell you about it.
Yeah, I will just start from a place of just pure gratitude for all of you. Lots of established investors, people that have been working with us for years, lots of new people this week reaching out, and it means so much to Nick and I. For many of you know us, and you're just going to be nodding your head like, of course, that's Nick and Elaine. But for those of you that are newer to us, this is very different than other presentations you might see. Of course, it's about real estate. Of course, it's about getting good deals and underwriting them very well and managing them very well and making sure there's profit there. But it's really about dreams and families and lifestyle. And I have been moved to tears so many times today, seeing so many people commit to our fund before even seeing the webinar. And we had a meeting with our coach earlier today, and just talking about the sacred responsibility that we have and how seriously we take it, that so many of you have placed your trust in us, and many more of you will place your trust in us tonight. And that's what keeps it fun for us. That's what makes it really exciting. I think you guys know we're big goal setters, right? Many of you were here just last week for our goal setting extravaganza. Part 2 is next week. We set some big goals for this fund, and with this group, because of you guys, we have exceeded those goals before the webinar. So we get to come to this webinar and just enjoy each other. Yeah. And just live in gratitude. And we'll make sure we get through all the content. We'll make sure we answer all of the questions, but I just want to make sure that we start from a place of gratitude and just thank you all for coming, for being a part of this, for working on our earlier deals, for helping with this, the biggest deal of our career. And we are so excited. Yeah.
So hopefully everyone has seen the link there for blackswanfund1.com. Go ahead and check that out. And without further ado, we're gonna dive in here. We're gonna talk about our private equity fund that we're launching here, and then about the Nicholas and Oliver apartments that are going to be the cornerstone for that fund. So
yeah, it will be a little bit different than some of our other webinars in that we're going to go through the content first and then answer questions, just to make sure that we're able to get through. It's 90% similar to other deals that we've put together. It is a little bit different though, and we want to make sure that we have a crystal clear presentation for everyone. And then also, since we're doing this a little bit later at night, we want to make sure that we're respectful of sleep schedules and those sorts of things. Of course, this is being recorded. The recording will go out to your email. It will also be uploaded to the investor portal deal room. So you'll have 2 ways to access that. And then the folks that are working as our producers tonight are compiling the questions and matching similar questions and those sorts of things. So put your questions in the chat as they come up. I don't want you to, forget something, but just know that we'll go through all the content and then we'll address questions.
I've just been going through a few disclaimers here, typical legal items here. So the law firm that is representing us for this fund is Premier Law Group. Maurizio, he is one of the most well-known figures in the industry. Does all the legal work for Brandon Turner, Open Door Capital, and all sorts of other very large players. We've really sought out the best people in the world to represent us in this exciting new chapter. And so here's our obligatory attorney language to throw in there. We're going to tell you a lot about kind of what we've done in the past and where this fund is going to likely go in the future. And just know that past performance is not necessarily indicative of future outcomes. And this is a variable rate return that has risk, as any investment has risk. So those are our disclaimers there. So if you're in this webinar, although this is already our most well-attended webinar, 107 people, so we had to bump up our Zoom licensing
did,
here for this thing. I think our previous all-time high was significantly lower than that. So I'm curious what'll happen there. But you probably know a little bit about us. We have over 9 figures in assets under management now, 500 doors. It's been an incredible year. We've just been so blessed this year. We've raised a lot of money over the years, and we've always repaid capital with interest, made payments to lenders and investors as agreed. Our sales team has been on fire, over 55 million in sales this last year, and we're doing a big townhome subdivision build right this second. That's pretty exciting. The Nest at Stonehaven, and then we own about 25 million, over 25 million now in real estate that we just directly own.
And I'll just slow down. So usually we kind of blast through this slide because we tend to work with the same folks over and over, but I do want to make sure we're giving a thorough introduction to our new faces tonight. So we're Nick and Elaine Stoggerberg. Obviously we're married to each other. I get the good fortune of hanging out with this guy all day, every day. We have 3 beautiful children. This picture is just so lovely that we stick with it, even though we do love our 3rd child a great deal.
One more on the way.
We have a 4th baby on the way. He's coming in April. I'm a psychiatrist. I trained at Mayo Clinic. Nick has a long career in technology through startups, and then actually worked at the Mayo Clinic and led 13 teams of engineers in what's called the entrepreneur movement. So starting a startup inside of the Mayo Clinic. And all along, we were building our own real estate investment portfolio over the last about 10 years. And then through that evolution, started working with other folks. Nick became a licensed real estate agent. He hangs his license at Keller Williams. That's where our Black Swan real estate team is. And we've really built this thing very organically, and it's very vertically integrated. So we have a real estate sales team. That's the Black Swan team. They represent Nick and many of our other agents represent us for all of our deals. We have a property management company that manages all of the assets that we personally own, plus all of the assets owned by our investors. That's the Black Swan Living Property Management. We've done lots of partnerships all the way from single family homes to 8-figure deals. We own a neighborhood of townhomes with some of the investors here on this call. And then there's currently 30 townhomes that are built. We're building another 85 for a total of 115. And then we're maybe even targeting some of the surrounding land to see how far we can push that townhome subdivision. And it really all comes back to when we started investing, we invested by ourselves with our own money. We did a lot of our own sweat equity pre-children. I was in medical school. We were crazy and we would stay up until 1 or 2 in the morning painting and laying tile and stuff.
I would just stay up talking to these folks.
Now we just stay up hanging out with you guys. This is a lot more comfortable.
It is.
And that ownership mentality, we're so grateful that our investment started as direct owners of real estate. So now as we're operating, over 100 million of real estate, we come at it from the perspective of owners. And we really think that way, and you're going to see that all through our presentation tonight. So that's a little bit more about us than we typically go into, but I want to make sure that some of our newer faces today know a little bit about who we are and why we kind of operate the way we do.
Absolutely. Why is a big word for us. We're very values driven as an organization. We think that if you do the right thing, everything else is going to take care of itself. And it turns out that being a landlord that puts the relationship with the tenant first is actually a really profitable business model as well. So we've got just a few of our values there. Growing authentically, focusing on long-term. We target an indefinite hold period. We've actually never sold an asset. We will one of these days, I promise. But we were going to sell one, and then apparently we're not selling it this year. So maybe we'll sell it next year. I don't know. We keep trying to sell it, but can never bring ourselves to do it. Focusing on an infinite rate of return. Our entire business model is a race to an infinite rate of return, creating infinite opportunity. and then showing up for people just like we're doing here, showing up for our tenants, showing up for our investors. You go ahead and block a time for a phone call here. You'll have an opportunity to do so if you haven't already, and I'm happy to do a 20-minute phone call with you here in the coming weekend if that's something that would be valuable for you. If you had a question that we couldn't get answered or something that you want to chat with us about. Ownership is not just a legal thing for us, it's a spiritual thing. We love taking extreme ownership of everything that we manage, everything that is placed into our care. It's something that we take very seriously. We believe in servant leadership. If we serve people, if we give, whatever finds its way back to us is going to be the universe's way of rewarding that. And that's kind of exactly what happened here with this opportunity, actually. And that's how all the best opportunities that have ever come to our life have come to be. And then just incredible transparency. I'm a big fan of the metaphor that I'm a terrible card player. I like to put all my cards on the table and just see what the best hand is that we can make, between the two of us. And some people have said I'm the toughest negotiator they've ever done business with. And I have a hard time understanding that, because I'm always just like, well, here's what I'm looking for. Here's what you're looking for. What can we do to create mutual value? And people find it very refreshing. And who doesn't love to just understand who they're doing business with and what's going on? Transparency is so unbelievably critical. As we go through the slides here, you'll see those values throughout the slides. So this is kind of start with the end in mind here. We're gonna kind of go through these values and how each part of our fund is driven by each of these values.
Absolutely.
So there's our motto, make the world a better place to live, in the most tangible sense of the word. This isn't something like trying to solve world hunger. We are literally trying to make the world a better place to live, buying properties that could use some TLC, that needs some renovation, or that has a property manager that's disinterested or disconnected and isn't taking care of the people that live in their charge, and literally making the world a better place to live. We're unbelievably excited about the difference we get to make.
Yeah. And the way we do that very tangibly is through our property management company and our asset management company. So physical renovations, management renovations. And we want to take this thing really big, because we think we can impact so many lives, investors' lives, residents' lives, the lives of people in that surrounding community. And so we want to do that through a $1 billion demonstration. So that means we want to have $1 billion of assets under management. We've set like a 5 to 7 year goal for that. I think with the
getting there sooner than we expected.
Yeah, the support and partnership of all of you, we may hit that much faster. And really, it's about lives. So internally, we say, $1 billion, because we have to have real estate metrics that people understand, but we want to impact 1 billion lives. And we have big goals to do that. Creating abundance for everyone. We really think that it's not about slicing up a pie. It's about making more pie. And how can we do that? How can we all get into the kitchen together and do that? That's so much more fun than sitting around a table and saying, I'll take a small piece so that you can have some. That's great, right? That's like 101, but let's just make more pie together. That's 201. We give away our entire playbook. So if you go to Single Family at Scale, we have a course. That's an entirely different thing, but it's also very revolutionary. It kind of fits in with our model that it's a give what you can model. We could have priced that course at thousands of dollars. Instead, we set a minimum of it of $100, because we want real estate education to be available to anyone who wants it. When we started investing in real estate, I was in medical school and not working, and Nick was working. We were hoping for a baby. We didn't have a ton of money. And we want to make sure that people like us can participate in real estate investing. Lots of people give thousands of dollars to that, because 100% of revenue goes to charity. And then eventually we want to give it all away. So that's a big part of the big mission that we have. We follow Warren Buffett very closely, other people like that, of how can we really move the needle in capitalism and then use that to move the human experience. I
don't want to get ahead of ourselves here, but we have some pretty big goals, and we think something very interesting is happening here tonight. So with this fund, 5% of our ownership of the fund is going to go to our staff, to our team, and 5% of the fund is going to go to charity. And if our investors want to match that give, they certainly can after they've received the return of capital. And our vision is to one day create a zero rate of return fund, where you put in your capital and you get 100% of the return, same structure. We get nothing from it. And after a few years, a thing has been created that can give forever. I try to imagine a world where you walk down Main Street and half the buildings are owned by for-profit enterprises that ultimately drive charitable giving. Our lender that we're working with on this deal, Bremer Bank, is a for-profit enterprise that's owned by a foundation. So 100% of the profit from that enterprise ultimately goes to charitable causes. That's just the most beautiful thing ever. And if we can change capitalism in just some small way, we'll die happy. We'll feel like we've had a good life's mission. So we'll see how far we go, but we've got some big goals.
Yeah, absolutely. All right, let's jump into a little bit about some of our core values of growing authentically, focusing on the long term, and creating infinite opportunity. So we've been real estate investors for over 10 years. We've done over 100 deals ranging from single family homes to large multifamily communities, over 100 million in assets under management, 500 doors that we manage with our property management company. We've never lost money on a deal. We take that very, very seriously. Before we were real estate investors, we ran a very small car dealership. We did lose money on one of those deals of the several hundred deals that we put together there.
Still burns me to this day.
Yep. So it is
$100.
We did. Yep. But never on a real estate deal. We've never failed to make a payment to any of our investors or lenders. Take that very, very seriously. Stay very liquid, have a lot of reserves, have a lot of conservative underwriting to make sure that that happens. We used to be able to say we had never had an eviction. We did have one eviction this year, largely because of the eviction moratorium. We really weren't able to work anything out with that tenant. And so we were forced to go the legal route. It was very peaceful. We ultimately got rental assistance to make sure that property owner was made whole. They did have a month of vacancy that was unexpected. But overall, we're very, very pleased with our outcomes there. We work really hard to have a turnover vacancy far less than industry norms. And we do that going all the way back to when tenants move in. So we have a lovely meet and greet process where we welcome our new residents into their new living experience. And then we take very good care of them all the way through with maintenance, customer service, Christmas cards for Veterans Day, so that when it's time to make that leasing renewal decision, they're excited to live there. They're kind of ruined on us. They say, I can't ever go to any other rental because I know I'll never be treated this well. And that's good for tenants. That's good for the community. That's good for those families. Think about, children being able to stay in the same home for years and years and years and go to the same school, as opposed to moving from one rental to the next. And then of course, it's very good for investors as well, because that drives down significant costs with vacancy and turnover costs. You're going to hear a lot tonight about how we focus on an infinite rate of return. We have a very different financial metric than many other real estate investors. So we acquire properties, we improve them either through physical renovations or management renovations, often both. That drives up the value. We then do a cash out refinance to take the capital out, return that capital to investors, or buy more real estate with it. And then in that period afterwards, hold the asset for as long as possible, because then at that point, there's no cash in the deal. So if you're looking at like a cash on cash rate of return and the denominator is 0, well, then you have an infinite rate of return. Or if you're looking at an annualized rate of return, cash is the denominator there as well. And so if you're dividing by 0, that's an infinite rate of return. We work really hard to minimize that time. So we shoot for like a 2 to 3 year period. In the fund, we're going to recommend that you think of this as like a 5-year time frame. We want to make sure that we're under promising, over delivering, but hopefully it's more like a 3 to 4 year time frame. And then of course, the disclaimer that our past outcomes, don't always necessarily predict our future results. Whoever could have predicted COVID, lots of other things. But we work really hard. And because we're so close to the management, both as the asset managers and the property managers, we're able to really look for efficiencies, look for opportunities, look for ways to up-level the experience for everyone so that we can have these outcomes and share them with as many of you as possible.
Awesome. So let's talk about why money invested here is different. There's lots of places that you can invest your money. Why would this be something that would be interesting to you? Why is this something that would be a compelling opportunity? We've talked about how we focus on an indefinite hold period. Warren Buffett will tell you that you should target an indefinite hold period for any investment, because if you are targeting, say, a 2 to 5 year hold period, you're probably going to make short-sighted decisions. And you'll see over and over again that that mindset drives everything that we do. We do really high quality renovations on our properties because we're targeting an indefinite hold period. So a lot of syndicators out there, they might paint old cabinets or refinish old laminate countertops, and we just rip it all out and put in new premium solid wood cabinetry and stone countertops that are still going to look great 30 years from now. That's not something that has a great ROI necessarily in the short term. If you're trying to do a short term flip, you can get a big bump in sales price by refinishing those countertops, but they're not going to look great a few years from now when that refinish wears off. And the end outcome is it's real value that's created for the community. We're not putting lipstick on an old asset. We are reimagining that asset. We are returning it to its former glory. We're under contract on a couple different 100-year-old buildings right now, 100 years old. And I cannot wait to dig into those and make them look as good as the day they were built. We're not looking at like an internal rate of return or cash on cash rate of return or anything like that. We're racing to an infinite rate of return. So it's a very different way to underwrite the asset. If there is a clear path to get to an infinite rate of return, then this deal makes sense. And if there is not a clear path to do that, then this deal doesn't make sense. It makes our underwriting incredibly straightforward and very qualitative in nature. It's something I feel like people can very intuitively understand. I guess I'm convinced that most people don't actually know what an internal rate of return is, even if they know how to generate one or have some sort of calculator or spreadsheet that can. Well, this investment is a 15% IRR. This one's a 12% IRR. Is this one good and this one's bad? I don't know. It's very difficult to make sense of those numbers. Whereas if I tell you one asset can return capital in 5 years, another asset can return capital in 3 years, very intuitively, you know that one is better than the other, and you probably have a good idea of by what margin. It's we try to keep everything unbelievably simple. Doing deep value adds because we are focused on the long term. We're not doing a $2,000 or $3,000 per unit remodel on our apartment buildings. We're doing a $20,000 or $30,000 remodel for our apartment buildings, and even larger remodels for our single family homes. Another thing that really makes us different is that we own a property management company, and we believe that management is the thing that matters most. So in our coaching, we have seen people that get the best price on an asset, that get the best loan on an asset, that buy at the right time in the right market, but they don't have that property management piece filled out or figured out. And it takes one train wreck tenant to kind of ruin everything. And conversely, we've seen assets where people paid too much and got a terrible loan and messed up the rehab and just made every mistake in the book, but they had really good management in place. And so year after year, good tenants were put in those properties and they got a little bit nicer each year. And over the period of time, like you eventually have a very successful asset indeed. So we focus incredibly hard on property management. We don't want to even think about investing in another market until we have an amazing relationship with a property manager in that area. And almost all of our assets at this time are in southeastern Minnesota. That's where all the funds for the Black Swan Private Equity Fund are going to go, where we own the property management company because we think it's so crucial. We don't necessarily bring all these things in-house. Like we don't have an in-house construction company at this time. We have vendors, contractors that we hire for that, but we have in-house property management. Putting the needs of the investors first. So this fund has no asset management fee, no acquisition fee, no capital event fee, no disposition fee. And our investors get 100% of the profits until they get all their money back. And we think this is just the right thing to do. This is the thing that aligns incentives and makes people unbelievably excited to do business with us. We could probably charge some fees, and almost everyone else does. I've not heard of a private equity fund before that has no fees. We even struggled to onboard with our attorney because
he's like, well, what about this fee? And we're like, well, not that one either. And he's like, okay, what about this one? Nope, not that one either. Like the whole first page of the form, we're like, let's just put an X on that. And he's like, are you sure? Yes, we're absolutely sure. If we're asking folks to invest in real estate and to profit from that real estate, then that's the only way we should profit too. We should not have this separate bucket where we're profiting from fees. We should say, hey, we think this is a really good deal. We want you in on it. And we're not going to profit until all of your money is back. And then we'll share in those profits together. And I want to stay focused on the fund and Nicholas, but really our big lifetime goal is to change capitalism, is to change the way funds are raised in private equity so that our model is the model, so that there's an alignment of incentives and there isn't a group of folks who are making money by putting deals together and then a group of folks who are maybe making money on the actual deal. It's either a deal where everyone makes money in the same way, or it's a deal that doesn't happen. And that's our lifetime goal. Now, you know.
And likewise, we align interests with our property management company as well. So most property management companies, they have a model where it's a fixed billing model where you bill back for costs like the HR, salary, you know, payroll and benefits, a fraction of the cell phone bill for the property manager that's assigned to that property, or mileage on their vehicles. And then a small percentage of the income for the property management company is the actual gross rents for the building. Time and time again, we've taken over apartment buildings or single family homes where the property management company is making money and the owner is not. And so we have a very radical model where we are paid on a contingency basis. If the asset is not generating income, we don't get paid. So with a typical model, it's possible for incentives to become very disaligned where the property management company is not making money, there's no way the property management company actually can lose money in that model, even if the owner is losing money. And with our model, that's very much the case. If the owner makes money, the property management company makes money, and vice versa. We have almost always reduced overall expenses, and that actually makes sense, right? Because if I am passing through all of my expenses to the assets that I manage, I don't really have much of an incentive to get on the phone with my cell phone company and say, hey, how can we reduce my phone bill? Or why are there so many mileage charges? Or why is our accounting so expensive? But because we internalize those costs and we are responsible for 100% of those costs, we have a huge incentive to keep expenses low. It's common for us to cut the total property management expense as a percentage in half. And I don't think we've ever taken over an asset where we haven't reduced the property management expense. So it's a very different model from the typical property management model. And if we create a profitable asset and raise rents, we have a profitable property management company. And if we don't, then we don't. And we really love that. Anything we can do to align incentives, we know is going to create the best outcome for everyone that's involved. So if all these high-minded ideas seem a little too abstract for you, let's make this incredibly simple. We have a very simple investment thesis, and that's that if you buy high quality assets, high quality properties in a good location, and you take really good care of them, and you plan on holding them forever, you're going to be very successful. And we love to increase the velocity of capital. So we'll buy with cash, do a cash out refi, and then be able to redeploy that capital very quickly. So it's truly this simple. You buy good assets in a good location, you take good care of them, and you put your capital to work. And that's all there is to it. We don't need to get too fancy about this. And this has been very successful. We've got a quote there from Warren Buffett. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. With Nicholas and Oliver, that's exactly what we're doing. And I think Warren Buffett would be proud if he saw the deal we put together here.
I think if you understand this one slide of everything that we're going to talk about tonight, you will understand the Black Swan Fund, Fund 1, Fund 2, all of the funds in the future. It can really be boiled down to it's this simple. You know, a child could understand this. They may not understand velocity of capital, but they probably would understand if I give someone money and then I get that money back, I can spend it on something else. And it just comes down to doing this over and over and over again and getting better and better and better at it. And then doing it with the largest amounts of capital in the fastest way to really accelerate that growth. It's truly that simple.
So why are we such proponents of this indefinite hold period? Almost everything out there is a short-term play. It feels like to me. Why are we the ones that want to hold things forever? We actually really struggled to structure our fund from a legal perspective because we're like, oh no, we want to keep these things forever. And they're like, oh, well, no one does that. We're like, yeah, but we're going to do that. So how can we structure the fund to support that? And it was actually surprisingly complicated to make that happen.
I do want to interject to make sure that there's some crystal clarity here that this is not saying that your capital would be in the fund forever. Right. We want to return your capital as quickly as possible. Again, we're saying plan for about a 5-year hold. We're really going to work our tails off to make that a 2, 3, 4-year hold period. And then you have all your capital back And then you continue to have the ownership in the fund that will distribute quarterly cash flow, and then also participation in future cash out refinance events and future, sale of those properties. So I do want to be really clear there. I've had a lot of questions this week about, well, is my capital in the fund for 15 years or 20 years? No, we want to get your capital back as quickly as possible. When people ask us, how do you guys personally own like $25 million of real estate? Where did you get the money for all of those down payments? We started with a very small bucket of money, spent it, improved a property, did a cash out refi. The bucket got bigger, went and did it again, went and did it again, went and did it again. The bucket got big enough that we could buy 2, 3, 4 properties at a time. Then the bucket was getting bigger and bigger and bigger. It's that same model that we're doing here. So we hold the property indefinitely. You can kind of think in your mind like a 15 to 20 year hold. We want to push it as long as possible so that there's as many years in that infinite rate of return, but the capital will come back to you as quickly as we can possibly make that happen.
Yeah, absolutely. Only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. That's exactly how we approach it. So the property we were thinking about selling this year, we bought that property 7 years ago or something like that. And the way we structure these deals, it's possible there could be a downturn. It's possible that interest rates could go up or the market softens. But for the most part, cash flowing residential real estate continues to cash flow. If it's cash flow positive today, it's probably going to be cash flow positive tomorrow. COVID has largely proved that. And we know that if we buy high quality assets and take great care of them, we're going to be okay if we just hold on to those assets for a long period of time. If we can have a clear business plan to get to a full return of capital, we don't really care very much what the future looks like beyond that. And we know one way or another, we're going to be okay. We could put together an incredibly complicated pro forma to say, we think that rents are going to go up 3% each year and expenses are going to go up 3% each year, or it'll be 4% next year and 7% the next year, or whatever the economists are forecasting. But it turns out that that those projections are rarely even a remote resemblance of reality. And we're kind of kidding ourselves by trying to engineer such a complicated model. If we can just focus on the immediate future and get to an infinite rate of return with a high quality asset, we know that history looks upon that strategy very favorably.
Yeah, when we had our call with our coach today, that's basically what we said of, we can have some models. Obviously, we try to understand macroeconomics and interest rates and where rental rates are going and how the population's growing or not growing and how jobs are growing or not growing. We try to stay, very ahead of that. But at the end of the day, there's so many things that are not predictable. Again, whoever would have predicted COVID, and then who would have predicted COVID, but that COVID would raise rents by so much. These things are, impossible to predict. That's why our company is named Black Swan Real Estate, that it's impossible to predict when you'll stumble upon that black swan. But we do know that we'll work hard, and we do know that we'll figure it out, and that there will always be a way, and that we're acquiring assets that can weather storms, that produce cash flow. That's a big part of the business plan. Historically, it's very, very, very unlikely for cash flow to go down even during a recession. So as long as that asset's continuing to produce cash flow, then we can ride out any storms, figure out a business plan, figure out how to make that asset as profitable as possible, and just keeping in that infinite rate of return as long as possible.
So the next few points, this is something that's very spiritually important to Elaine and I. We make a very conscious decision about our business model and the way we do business, and it's second and third order consequences. So if you have kind of a tale of two cities, let's say you have one apartment building where a different syndication group buys and sells that asset every 3 years over, say, a 10 or 12 year period, and you have a different ownership group that holds that asset over that same time period. Let's think really carefully about the impact that has. Those tenants, if you're targeting an immediate sale, you really just care that the tenants are paying rent, right? You don't really care about building a long-term relationship with those tenants. The property management company is in all likelihood changing when that ownership group changes over and over again. The local, city government that's, trying to cooperate with you on reducing crime and improving the community, you don't really care about building a relationship with them because you're probably going to be gone in the not so distant future. And ultimately, the asset itself is going to struggle because you're not going to make those decisions that will be rewarded 10 years from now, putting in energy efficient improvements to the property, or changing the exterior facades of the property that just create a handsome look that will generate long-term appreciation, but aren't necessarily going to create a bump in your sales price next year. when you focus on the long term, all of a sudden, everyone's interests become aligned. The next door neighbor is giving you referrals to high quality tenants because they know that the tenant that lives there is going to be their next door neighbor for quite some time. Indeed, we hear a great deal, in fact, about who we recruit to be our ideal customer because they're going to live in our properties for quite some time. We do high quality renovations we love on that property because we know that the long-term return on investment is going to be huge. Oh, and by the way, this is actually a really profitable business model because when you make all these long-term investments, they pay off big time when you get to years 4, 5, 6, and 7, when your energy expenses are lower, your utility expenses are lower, you have almost no tenant turnover because you have this group of elite tenants that you've recruited over the course of several years. Your maintenance and CapEx costs are drastically lower because you've put so much money into that asset on the front end of the deal. You don't have the city trying to trick you into, repairing things through whatever maneuver they can come up with because you've just taken such great care of the asset and you have such a great relationship with them. I'm actually having lunch with our director of community development here in Rochester here in a few days, just building relationships there. And then, by the way, the IRS really loves this. It really rewards this. So some people think that they're being really clever investing in real estate, that they found some sort of tax loophole investing in real estate. And the IRS knows exactly what it's doing. So if you are a flipper, if you go flip a single family home, you pay a 50% tax rate essentially on that. They really don't like flipping. What the IRS subsidizes is a food and shelter. So if you're providing affordable market rate rental housing, and especially if you are improving that housing, putting money into that property, the IRS really loves that and subsidizes the heck out of it. And that's how Elaine and I have not paid any income tax in many years, because we do what the IRS wants us to do. If you invest in a real estate property, you can do cost segregation, accelerated depreciation, bonus depreciation, and get all sorts of tax benefits, particularly in the first year and the first several years of ownership. But then if you go to sell that property after a few years, you have to recapture that depreciation and you lose all those subsidies. Whereas if you refinance the property to get your money back out of it and hold that property for the long term, you get to keep that depreciation, you get to keep those subsidies for as long as you care to hold the asset. And that's what the IRS loves and rewards in a huge way. And this private equity fund is going to generate incredible tax incentives, even in 2021, because we'll be making a big closing here by the end of the year. That is not some clever thing that we've done, not some loophole that we found. We're simply doing what the IRS thinks good people should do, and it's rewarded handsomely.
It's also very important to note that a cash out refinance is a tax neutral event, whereas a sale is a taxable event. So that's another big part of why a long-term hold is so valuable, because we can cash out refinance properties many times over, say, a 10 or 20-year hold. And each of those large injections of liquidity are tax-free events. And it's always nicer to have tax-free money than it is taxed money.
I see lots of great questions pouring in. We're going to answer those here when we get to the end of the slide deck. Show up for people. Again, we're here. We're showing up for you. We show up for our tenants every single day. We think it's so unbelievably important. On the drive here, I got a text message from one of our neighbors that complained about trash in front of one of our properties. Those tenants actually recently vacated. That's why the trash bins were left out. So I said, hey, that's what's happened there, and our team will take care of it tomorrow. We actually go door knock neighbors and say, hey, we've purchased the home next door. If you ever think that we need to know about something, please reach out to us. This is literally the 180-degree opposite of what every other property management company does, which is, see no evil, hear no evil, out of sight, out of mind. We love to engage with the community, to show up for people, even when they may be surprised that that's happened at all. It's unbelievably important.
All right, let's dive into some more technical details. So we live and invest in Rochester, Minnesota. And those of you that know why we love Rochester, of course they invest in Rochester, but many of our new folks tonight might be thinking, well, this isn't a city I've heard of before, or, it's not one that I hear kind of consistently as an investment market. And that's part of the reason we love Rochester. We really think of Rochester as an extremely strong investment market that produces both cash flow and considerable appreciation. We're going to talk about where that appreciation comes from. And it's kind of a hidden gem. So Rochester, Minnesota is about an hour and a half half south of Minneapolis, St. Paul. It's the third largest city in Minnesota. It's home of the Mayo Clinic. That's the largest employer here. Mayo is consistently ranked the best hospital in the country, the best hospital in the world. And more than just the employment opportunities and the economic drivers of Mayo Clinic is the culture that comes from Mayo, and that bleeds over into the whole city. So Mayo has a 100-year strategic plan about how it can become and stay the best hospital in the world, and kind of always be that bleeding edge, always be a place of hope for people. And that, when a great portion of the population works at an enterprise like that, you see and feel that in the community everywhere you go. The Destination Medical Center initiative is really important. I would encourage all of you to take a peek at the website. It's just dmc.mn. And Rochester seeks to be the destination medical center of the world. And it's the largest ever public-private partnership in the state of Minnesota that brings together dollars from the state, Mayo Clinic, IBM, Google, Apple, a number of other smaller startups that's seeking to double the population of Rochester so that Mayo and these other organizations can have a good, high-quality workforce. So not only is the population growing, the number of very good jobs of skilled professionals is growing, and that leads to the value of real estate increasing and also rental rates increasing. So we know that the population of the whole country is increasing, and that's a big part of the reason why we're in a housing crisis as a country and why it's so great to be a real estate investor. In addition to that, Rochester has some very strong economic drivers that kind of stack on top of the already great economic drivers in the country. The assets that we're targeting are around the areas that are designated by the Destination Medical Center for receiving a lot of the infrastructure dollars. So things like new roads, new schools, new parks, new buildings, all of those things are improving the area, and we're gobbling up all of the real estate around that as much as we possibly can. The Nicholas is actually included in the Destination Medical Center map to give you some perspective on how valuable of an asset the Nicholas is. Rochester behaves like a secondary market, even though it's a tertiary market, because even though the population is rather small, it has these big economic drivers from Destination Medical Center. And at any given time, the population is much larger because of the people that are here for healthcare.
Rochester is the smallest city in the entire country by population that has a Class 4 high-rise building.
Yeah.
So there's a larger downtown in Rochester, community of 250,000 than there might be in a community of 500 or 750,000. It's a really neat area.
Yeah. Nick was born and raised in Rochester. So I think Rochester has some good outcomes. Left and lived in Oklahoma City for about 15 years. And then we came back here for my training at Mayo. In addition to Destination Medical Center and all of these economic drivers, Rochester has a long history, a 30+ year history of consistently being rated the best place to live, the best small town in America, the best place to raise a family. And that goes back to the early 90s of things like Money Magazine, Forbes, and Rochester continues to win those awards today. But we love that there's a long history of that. Rochester is rated one of the most recession-resistant cities in the United States. It was actually ranked in the top 5 recession-resistant cities in February of 2020. That's a really important time because the world didn't know that COVID was coming. COVID was probably out there, but we didn't quite have our hands on it yet. And we saw that through COVID. Rochester has fared very, very well. Mayo Clinic has fared very, very well. The details are a little more than we could probably share tonight, but Mayo kind of shut down, just like every hospital in the country did some furloughs and those sorts of things. And then through the recovery, actually repaid all of the employees. So the population was made whole through that. Fairly affluent community because there's so many very skilled professionals, folks with a lot of education here. And then as investors, the big reason we love Rochester is because it cash flows. There's still great opportunities for cash flow here that aren't available in many other markets, but it also enjoys a great deal of appreciation. So it's kind of the best of both worlds, and it has allowed this business model to evolve to purchase those cash flowing assets, drive up the value, get the cash out refi, but also know that if at some point in the future there's an economic downturn or interest rates go up or something like that, these assets will continue to cash flow. So it shields from risk. High regulatory climate here. So a very strong rental authority that inspects every single apartment building, also every single family home. A person has to be a licensed property manager. So both Nick and I are licensed property managers, and then every property itself has to be licensed. And we actually really like that. We lean into that regulation because it makes it hard for, quite frankly, it makes it very hard for slumlords to do well in Rochester because there's so much regulatory burden. It makes it hard for big institutional players to come in. And we've seen that in Oklahoma City with the assets that we have there, where like a whole neighborhood will be purchased and turned into rentals with kind of a ho-hum property manager, and the neighborhood just kind of deteriorates and rents actually go down. It's very unlikely that anything like that would happen in Rochester because of the regulatory climate. And then we have the Google Maps link there. So this is Rochester. This is the Zumbro River flowing through it. There's the Mayo campus that you can see there, the skyline. And Nicholas is right next to Mayo Clinic. It's walking distance. It's just one street over.
So let's talk a lot about specific location, because we're doing something quite special here that we're very excited about. In the last several months, we've assembled, we've agglomerated a number of urban core assets in a very surgical and targeted manner. So everything that's in a green box is an asset that we already own. This is Zick Apartments, Lofts Apartments, Uptown Landing. Everything that's in yellow is a property that we currently have under contract. So this is the Raymond Apartments, Nicholas Apartments, Oliver Apartments, Furlough Apartments, Hamilton Apartments, and then things that are in orange are properties that we're aggressively targeting right now. So you can see there's a lot of immediate neighbors here that we're aggressively targeting. These red boxes here are the two principal Mayo campuses. So there's the Mayo downtown campus on the right and the St. Mary's campus in the bottom left here. And 2nd Street here is going to be going away here in the not so distant future. This will become St. Mary's Place. So I had a little screenshot here, or just I'm on the DMC website. Go to dmc.mn. This is not secret stuff. These are published maps about what the development plans are for the future of Rochester. So right now this is 2nd Street. There's just a bunch of vacant lots basically that Mayo Clinic owns, parking lots, and they're going to have a whole bunch of commercial infill right here. And essentially these assets that we're acquiring immediately surround this development district here. So you can see that we're building something really special, really unique. We're buying assets that are in what I would call a sour spot in terms of size. So they're frequently too big for a mom and pop to buy, say 20 or 30 unit apartment building. So most, if you're a husband and wife that want to go try your hand at being a landlord, you might go buy like a 4-plex or maybe a 6-plex. So there's not a lot of buyers that are just, small local people, but they're too small for a large, institutional player to target as well. They really want to buy something that's at least say 100 units in size. And we're buying buildings, some of which are C class, some are B class, and some are A class. We're renovating those C class buildings to be B class buildings. And then the A class buildings, which are Nicholas and Oliver, they have what's called a halo effect. So they kind of raise up all the assets around them. Chevrolet makes a Corvette, not because they sell a lot of Corvettes, but because people go into the dealership to go look at a Corvette and they drive away in a Chevy Cruze or whatever, kind of normal class B car we'll say is. And a lot of these assets, they're too small to really shoulder a really effective marketing budget. And they're not assets that market especially well. Whereas Nicholas is just such a handsome asset that it's easy to draw leads. In fact, too many leads. And those leads can then go to these other assets in the campus. We can easily field a rock star team of maintenance personnel, of leasing personnel, and they never need to get in a car to drive between these assets. And so you're able to get a quality of management on these assets that you typically you just can't have on a 20 unit apartment building. You just can't staff that building because you just don't have the economies of scale to make it happen. Or my favorite anecdote here is snow clearance. So we just signed our snow contract here, and we got a power broom. It's like a giant rotating brush, bristle brush. and it's so effective in clearing snow. You don't have to put any salt down. So not only is it the most crisp and pristine way to clear snow, but you have some cost savings as a result of not having to put down salt, and it doesn't mess up your sidewalks and stuff over the years. But it's very expensive to move that equipment around. Well, with this campus, they literally never have to get out their equipment. They just keep driving down the sidewalk. So we're able to get snow clearance that's, the Cadillac of snow clearance for a fraction of the price of what it would normally cost, because we have this kind of agglomeration. And finally, once we've put this package together, it is suddenly appealing to an institutional player. It's no exaggeration to say that, Blackstone would be interested in buying this package when we get done with it. Now, we're not targeting a sale in the immediate future, but we do want to start with the end in mind. There's no luggage racks on coffins. And so we're creating something that did not exist before. I think that almost every, REIT or real estate focused private equity fund in the country would love to buy a $100 million portfolio of residential real estate on the doorstep of the Mayo Clinic. They just don't want to do it 20 units at a time.
Absolutely. Let's talk about the targeted assets that will go in the fund. So the fund will include both multifamily properties, and we really target buildings that are at least 20 units. We'd be open to a smaller building if it's like right next door to something else that we own, but really want to have some economies of scale in the individual buildings that then, as Nick mentioned, come together to really drive the efficiencies. And then also single family assets. So many of you have come to us via single family at scale and the work that we do talking about single family. We love single family rentals. The population loves single family rentals. There are a lot of demographic changes of people postponing home ownership because of things like more years of education, student loan debt, postponing marriage, postponing children, but they want to live in a single family home. And so they rent for much longer than previous generations. So we'll have both in the fund. And that's really good because it also blends some of the risk and blends some of the opportunities that come from those different asset classes. We're mostly targeting high quality Class B properties. We kind of venture into some A-, and we'll venture into some C+ if we feel like we can renovate them into a Class B, but really finding that sweet spot there of what we consider to be very, very purposeful housing, right? Like people want to live there because it's a nice, good, safe place. It maybe doesn't have all of the amenities of that Class A++ down the street. It also has a more affordable price tag, and it's a good sweet spot in terms of managing any type of recession or changes that happen. We're looking for that value add potential. Again, that can be either through physical renovations or management renovations. It's most often always both. Sometimes a yield play if there's a favorable outlook there, but I would say the extreme majority of our assets have a value add potential. And then in this fund, this $10 million fund, so we will use bank leverage to get about $65 million of assets. Part of that is you might be thinking, okay, 10 million, but usually you have to put about 20 or 25%.
How'd the number get so big?
Usually you have to put about 20 or 25% down. So shouldn't you be acquiring about 40 or 50 million in assets? The debt terms on the Nicholas are so favorable that really allows us to purchase so much more with this fund. So the ideal mix will be this one large multifamily property. So that's the 95 units that are from the Nicholas and Oliver. And let me just kind of clarify that there. So Nicholas and Oliver, if you look at them from the street, look like they're separate buildings, but they're actually like a hybrid or like a Siamese twin. They share a parcel, they share ownership. And then they also share the heating and cooling system. They had to be built this way to meet architectural guidelines in the city. And then several medium-sized multifamily properties. Nick showed the map there of what we're targeting. We don't have those under contract yet, but we're working our tails off to get those under contract. And then also some other multifamily properties in the city. And then a big group of single-family homes as well. All of the money in this fund will be spent in Rochester / Southeast Minnesota. For example, our townhomes are in Byron. That's a community that we love. Pine Island is another community that we're targeting. Mankato is another one. There's a university there that's quite strong. And more than anything, we're looking for opportunity. We're looking for how can we take something and make it more valuable. And Nick shared there, what's our long range vision? So how can we improve a property through renovations and management? That's the 1 to 3 year plan. in, but how can we create something kind of out of nothing or really drive the value? And we find that just putting this message out there, putting this vision out there to people in our community, brokers, those sorts of things, then the opportunities come to us. So this is what we'll be targeting in the fund. We're definitively closing on Nicholas by the end of this year, and then the other dollars in the fund will be spent on these targeted assets.
So let's talk about some, brass tacks, the exact structure of the fund. So usually you need a spreadsheet to kind of talk about how the fund is structured. There's a pref and a catch-up pref and a waterfall and a series of escalating splits and all kinds of mechanisms that on the one hand can potentially incentivize good outcomes, but on the other hand can easily disalign incentives. So let's say there's a preferred rate of return in a fund, and the fund has a bad couple of years, and that preferred rate of return accrues until there's a 20 or 30% debt essentially that the active partners owe to the passive partners. Well, those active partners may suddenly be incentivized to exit because there's just no future where they make money, even if that's not necessarily the best outcome for the capital partners. Even if it would make the most sense or generate the best outcome to just hang on. There's a downturn in the market, and there's a light at the end of the tunnel. Spring is going to follow winter. Or conversely, let's say that year one or year two has just been an out of the park success, and because there's a really complex waterfall structure that is calculated based on days or months or weeks of the hold period for the asset, again, that active partner may be incentivized to sell, to exit the fund, to maximize their split in that waterfall structure, even if the best thing for the capital partner was to just hold on. You've got a really high quality asset that's knocking it out of the park. Like, why the heck would you sell something if it's doing so well? So we try really, really hard to make sure that our incentives are completely aligned at all times. This fund here, we're going to raise $10 million. It looks like we're at 7.6 million already. I'm just, again, just humbled and honored by the level of interest in the fund here. We thought it was going to take a month or something like that, and it seems like it might take a day. So the portal is open if you want to commit there.
I'll be hopelessly transparent that I set the goal today that I would love to fill the fund today, because our goal is to change the way capitalism is practiced. And this is a story that will change it, that when you radically align incentives, that when you put people first, when you put investors first, you put the community first, it's a simple structure. You take out all the fees. If we can say we filled a $10 million fund in one night, we can get some traction on spreading this message in capitalism.
So I was in a pitch meeting for a private equity fund here recently, and the fund manager, who's a kind of a caricature of a Wall Street persona, he's like, well, our analysts have found there's a huge alpha, and alpha is your gap in your outcome versus like the market outcome or whatever. So there's a huge alpha on ESG, that's environmental, social governance. So like doing the right thing, that's the sterile acronym for doing the right thing. So he's saying, it turns out that doing the right thing is surprisingly profitable. So we have a 17% portfolio allocation to ESG to try to ride the wave. It never seemed to occur to this person that doing the right thing was the right thing to do. And so if we can raise a $10 million fund in a day because we did the right thing, someone might pay attention to that, and it might change things just a little bit. I don't know. I don't want to get on a soapbox here, but that's
if there is one, that's it.
Yeah.
So let's talk just very brass tacks. We've kind of gone over this a couple of times in the presentation, but I want to make sure this is crystal clear. So we use that money to purchase real estate. We then improve that real estate. We then, that drives up the value of the real estate. We exercise a cash out refinance. All of the cash flow that's generated while we're operating the real estate, and then all of the cash flow from that capital event, that cash out refi, 100% of that goes back to the capital partners until all of your capital is repaid. How that will look, brass tacks, is you'll get smaller amounts during, say, those first couple of years, and then you'll get a large amount all at once, and then you'll be 100% repaid. After that, we're going to operate this fund as long as we possibly can with a 50-50 split of capital. And that will be the cash flow that comes. We'll have quarterly distributions. And then whenever there's either a cash out refinance event or the sale of an asset, then you would get a bigger check. So it'll be smaller cash flow checks and then bigger checks that come intermittently every, let's say, 3 to 5 years. And that's really about it. So if you can understand that, you understand everything about the fund. Of course, investors participate in all of the tax advantages. One of the great things about us having the opportunity to close on the Nicholas by the end of the year is we'll do cost segregation, bonus depreciation, and be able to give many of those tax advantages even in this tax year. And then there are ways to exit the fund. I do want to be really clear that most people should never want to exit the fund. So once you've received all of your capital back, you're then in that infinite rate of return period. You have that golden goose, so to speak. So you should want to stay in the fund for as long as possible to enjoy those returns as long as possible. But things happen, we understand that. And so there are ways in the contract for partners to buy each other out, for Nick and I to buy a share in the fund. And then there is a call option after 15 years. So again, I think these things are very unlikely, but we had to include them in the fund. And so there are ways to exit, but you should be thinking of this as that infinite rate of return for as long as possible.
So there's a couple questions there. Yeah, it's you get 100% of the profit until you get your money back, and then a 50-50 split after that. And that's really, really as simple as it is. And we'll circle back around to several of these questions here at the end.
Let's talk a little bit about what if things go poorly. So obviously, we're investing in assets that we think will be very profitable, that our pro formas, everything that we're looking at show that we project that these should be very profitable. But we know that things go poorly, whether that's at the asset level or at the macroeconomic level in the whole country. So things like rising interest rates could be a challenge. And so we need to think about our strategy there and how we're timing our refinances. Rising cap rates is a challenge for all real estate investors. Some of the ways that we're able to protect against those risks are having in-house property management. But then most importantly for you as the capital partner is that 100% of capital goes back to you until you're completely repaid. So there's a great deal of security and certainty in the early years of the fund where the capital partners have the risk of we're trying to minimize that risk as much as possible, as quickly as possible. The most likely worst case scenario would be that time frame that we're targeting for return of capital could go slower than any of us had hoped. And so then you have capital in the project that will eventually yield that infinite rate of return, but it's taking longer to get there. We have no pref, we have no waterfall, we have no fees, no capital event fee, no asset management fee, no any fee you can think of. We just don't have it. Someone asked about our split and why it is a little bit different than a typical split. And it's because of that. It's because we have no fees whatsoever. And so a typical model might look like it has a certain split, but then when you add in all the fees and the pref and all of those sorts of things, it really comes out to less favorable for the capital partners than it looks like. We abhor that model. We believe in radical transparency. Again, a high school student or even younger could understand this, and that keeps the incentives aligned.
Most critically, it protects us from risk. So with an exhaustive fee schedule, the active partner is taking a lot of money out of the deal on the front of the deal. So let's say that things go poorly. Let's say that we buy an asset, we hold it for 5 years, and 5 years from now, we sell it for less than we paid for it. Because our investors have gotten 100% of the profit along the way, it's almost mathematically impossible that they would actually not be made whole in the event of a sale. Now, if the active partner is taking a lot of fees out of the deal along the way, that becomes a very different possibility. So a worst case scenario with the way we've structured this is really one of kind of lukewarm return, essentially. It's almost impossible. Again, all investments are risky. There's always a risk of loss, absolutely. But because there are no fees, because there's not a lot of money coming out of the deal on the front of the deal, it makes it a lot harder to lose money on the deal.
Let's talk about a potential market crash. So
yes.
we don't think that one is coming for many years, but we are at the top of a market cycle, and a crash or a minimum a fall in values will come. That's part of the real estate life cycle, just like there's a human life cycle. This fund is not as sensitive to that because we don't intend to sell. So we're not saying, oh, we're going to buy these things and sell them in 3 years. Oh, 3 years have come and we're kind of sitting at the bottom of the market. I don't know what to do here. We'll just ride through it. Everything's cash flow positive. They'll continue to produce profit, and then we'll sell as values rise in the future or do that cash out refi in the future. extremely unlikely there could ever be a capital call because of this structure. There are no mandatory capital calls in the operating agreement. There could be potential optional capital calls if we needed capital and someone wanted to put that capital in exchange for additional ownership in the operating agreement. To date, we have never had a capital call in any of our partnership groups. We've never even come close. But of course, we want to make sure we're addressing that.
And then the most common question, what happens if we just spontaneously die? That is, I think, like the most common question just about for what goes wrong.
Yeah, so we have a trust, the Curator Heritage Living Trust. That's the trust that will own our portion of the fund. And we think a lot about that, both for our children, our own personal assets, but then certainly as we're working with other people's money and your livelihoods and your retirement funds and your futures. So we have a team in place. There would be a 6-person board of director with a 7th person to be a tiebreaker. That's the professional trustee. These are the real estate experts of our area. They would manage everything. And we've given them some guidelines, kind of like what we're sharing tonight, but we've not given anything prescriptive. We've not said, sell everything if we die. Well, what if we die in a crash? We want them to hold that and operate it and cash flow it. If we died at a time that the market was at an all-time high, we probably would want them to sell and to wind up the fund. Hopefully very unlikely to happen. We don't do risky stuff like skydive or anything like that. We're very well insured as well. So we've thought through that quite a bit. We've been thinking through these things for years, and we feel like we have a really good plan in place if something like that were to happen.
Perspectives, usually when you're running a vehicle like this and you are getting lending on an asset, the bank requires a special purpose life insurance policy in case the partner running the deal does pass away. What we do is we show our trust to the bank, and sometimes they are a little bit frustrated at first because it's kind of long and complicated, and then they have their legal team look at it and they come back and say, we've never seen someone put so much thought into what the world will look like when they're no longer a part of it, and we're really looking forward to being in business with you while you're still alive. And we've never had to pay for one of those special purpose life insurance policies on any deal we've ever done, because it's clear to the bank once they review our trust that if we did pass away, things are going to be just fine.
Yeah, we're a little over the top of the hour. We have some additional content to go through, so we're going to try to speed up a little bit. Those of you that know Nick and I know that we love to talk forever.
Yeah, there are a lot of really good questions we really want to get to.
Yep.
Lots of great questions about structure. Yep. Lots of details. So.
We will make sure we're going to get through the bulk of the content. We will make sure that all of the questions are answered, even if we're here just talking to the screen and you're watching the video replay yourself tomorrow or this weekend. We will make sure that all the questions are answered.
I believe we still have 130 people here, so people are obviously interested.
Yeah.
It looks like we're $3,000 short of 8. I feel like I'm on a telethon. We're $3,000 short of 8 million in soft commits at this time.
Yeah.
So maybe you want to be the person to break 8 million here.
Let's do it. We've talked a lot about the things on this slide because these are the things that are so important to us. This is what really makes it interesting for us because we're aligning incentives. We're all in this together. Some of the things that are important that we haven't talked about on this slide are some of the vertical integration pieces that we have. So if you remember way back to the beginning, we talked about how we have a very vertically integrated real estate investment company that involves our real estate sales team, the Black Swan team at Keller Williams. Nick's a licensed real estate agent. We have lots of other licensed real estate agents on our team. If our team were to represent the fund as the buyer's agent or the listing agent, we would receive a commission for that. That's not an acquisition fee. That's a fee that would be paid to any broker who represents the deal. And if we do not represent the deal, then we would not receive that commission. And then we talked about our property management company. So we really think of our property management company as one of our biggest strengths. So we are not just asset managers that are moving spreadsheets around and kind of having a theoretical understanding of things. We are working shoulder to shoulder with our leasing staff, our maintenance staff, our operations staff to operate these assets day in and day out. The first thing we have to do when we end this webinar is make phone calls to make sure that the townhomes that we own have water because of the water main break tonight. And so in addition to driving a lot of value and a lot of alignment there, Nick talked about our property management model and how we only collect if the asset is collecting. And then for those of you that have worked with us in third-party property management, we have some industry standard fees like a leasing commission or a rental certification commission, and all of those fees are waived for the fund. So it's simply 10% of gross rents that are collected, and that's it. nothing else. Very simple, easy to understand.
So if you're someone who's one of our third-party management clients, if you look at the really advantageous debt that we're able to get on a typical deal, we're able to really drive efficiencies on things like insurance, taxes, and then essentially reducing some of our fees. Your overall return should be relatively comparable. And if you're not familiar with that third-party property management product, all you need to know is that this is not a big profit center for us. This is something that we perceive to be mission critical to driving value to the asset. So our goal is really not to make a lot of money on the property management. Our goal is to create the most high quality property management experience we possibly can for our residents. And we know that that's going to drive massive value at the asset ownership level.
Let's talk about how you make money.
So we talked about how things can go poorly, and we've talked about how we make money because we love transparency so much. So let's get to the good part here and let's talk about how you make money.
Yeah, so we're starting to have some repetition here because this is so different. And especially for those of you that maybe have listened to a lot of syndication or fund pitches, we want to make sure that you understand how different this is. And it's so simple that the mind says, well, what about this or what about that? And so that's why there's some repetition here. 100% of profit goes to you until you're completely repaid. We hope that that's less than 5 years. We encourage you to think of it as like a 5-year hold. Historically, that's been less than 3 years. We've had lots of deals that we've been able to do that in about a year's time. Again, past performance doesn't indicate future outcomes, but that's what we hope for. That's what we're planning around. There is limited cash flow during that time because we're churning that capital into renovations, into improvements in the property, working on leasing turnover and increasing rental rate. So there is limited cash flow as we're pouring into the asset. And then we get to that cash out refi event. There's an infinite rate of return after that. A common question, a very important one, is, well, how much can we project there? We project that real estate generally produces about a 10 to 20% return on the initial investment amount. So if you put in, say, $200,000 into the fund, you'll get that $200,000 back, hopefully in about 3 years, maybe about 5. And then every year after that, you would get somewhere between $20,000 and $40,000 in returns that would come to you through a blend of quarterly cash flow distributions and then participation in future cash out refinance events and sale events. Predicting that payback period is relatively easy. So we can look at an asset, we can have a business plan, we know what the bank wants, we can think about what renovations and management needs to happen. So that's that, let's say, 2 to 5 year period. Predicting returns after that becomes a little more challenging. That's why there's kind of a wide range there of 10 to 20. Some of it is that it's far in the future. Some of it is that we know that Rochester is continuing to grow. We know that it's changing with Destination Medical Center. As we bring more value from owning more of the real estate, we're going to be able to drive more efficiencies, increase profitability. So that's a little bit harder to predict, but we're going to have that period for as long as possible and work as hard as possible to drive profitability. And when we talk about alignment of incentives, that's the only time that we profit in the deal. So you can be assured that we're not going to let our foot off the gas or be distracted by fund 2 or fund 3 or whatever we're working on. We're very incentivized to work really hard to make sure that that period is as profitable as possible and that we get to that period as quickly as possible so that you have your money back and so that we can participate in any of the profit of the fund.
We would love to make money off this thing, and we just have to get your money back to you first.
That's right.
So,
and then we talked about the tax advantages. So by delaying the sale as long as possible, number one, a cash out refinance event is a tax neutral event. And then also you're delaying that depreciation recapture as long as possible.
So from a really high level perspective, we want to make sure you understand kind of the pattern here. We're going to go through a very concrete hypothetical example here. Please keep in mind that this is not a pro forma. We can't, promise a particular type of return, and past outcomes are not necessarily indicative of future outcomes. But we really want to make sure that you have a super concrete example of the pattern of what these returns will potentially look like. So hypothetically, let's say you put $1 million into the fund today. If you put $100,000 in the fund today, then just divide all these numbers by 10. So a nice round number. Let's say you put $1 million in the fund. You could maybe get that $1 million back in the next 3 years, maybe the next 4 years, maybe the next 5 years. We can't necessarily promise what that payback period will be. We can tell you historically that it has never taken 5 years for us to return capital in any deal ever. In fact, historically, it's been a really short time frame, and we've had numerous deals where the return period is as little as a year and frequently 2 or 3 years. So let's say you put in $1 million, you get that $1 million back in 3 years. You'll receive, limited cash flow in that interim period as we're putting money into renovations, getting ready for our big refi. Let's say that you get $50K per year in cash flow from years 4 to 8. So far, it's not that interesting, right? So you got your money back. You didn't get a lot of cash flow at the start of it. And then you've gotten a little bit of cash flow in subsequent years. But yeah, it's not super amazing. And then in year, we'll say 8, and again, this is just an example, a hypothetical example. In year 8, we do our second refi, and you get $500,000 in cash, tax-free, because that cash payment is accompanied by additional qualified debt. And that's where this investment opportunity suddenly gets very interesting. And then that happens, that pattern repeats. So let's say that we continue to deliver really solid cash flow and refi every 5 years into the indefinite future. And that's what that pattern looks like. So you put in some capital now, you have kind of a muted short-term return that's not super interesting, and then it gets very interesting very quickly. This pattern is the basis for all the wealth that Elaine and I have ever created. Essentially, we're going to run this fund the same way we run our personal portfolio. And this pattern here is how we've managed to accumulate such a large real estate portfolio and have no cash in it. And it's how we've been able to grow our real estate portfolio so quickly, because we keep doing cash out refis to return capital to go purchase more assets. We're kind of delaying gratification. We don't have this really sexy sale in year 2 or year 3 where we get hundreds of thousands of dollars, but then we get $500,000 tax-free in a time frame that's very predictable and very manageable. And then all these numbers are in today's dollars. So most commonly, when you look at a pro forma for a fund, they're doing what's called a discounted cash flow analysis. So they look at future potential outcomes and say, well, rents are going to go up a little bit, and expenses are going to go up a little bit, and appreciation is going to go up a little bit. And we can walk through like a spreadsheet. We do have a little calculation we put together. It's in the portal just to illustrate how powerful that compounding effect is over time. These are in today's dollars. So 8 years from now, that 500K is probably not going to be 500K because of inflation and rent growth. So maybe it'll be 600K, maybe it'll be 700K, who knows? But these, just for the purposes of simplicity, we're illustrating this in today's dollars. All these figures are really punitively conservative. It would be really easy for us to say, oh, well, 5 years from now, rents are going to be 20% higher with organic rent growth. And then, yeah, everything looks amazing when the rents are 20% higher. We're projecting kind of a worst case scenario. We're looking at a year 1 pro forma, which is almost by definition the worst possible analysis, or least most conservative analysis you could possibly have.
And I'll also call out that in the years 4 to 8 cash flow there, that's kind of what we would consider to be like the worst case scenario, where, our projections are that it would be closer to like 10 to 20%. So with that 1 million invested, it would be closer to 100 or 200,000. Again, we kind of consider this to be like the most conservative thing that we can put out there.
Yep. I don't want to promise some, over the rainbow kind of scenario, but we're going to look at one of those here in just one slide.
Yeah, so let's look at some of the deals that we've put together.
Sorry about that.
Oh, we use a very beautiful font called Banya, and the numbers.
The licensing keeps getting screwed up.
Yeah, this is new 52 apartments. So now we're talking about deals that we have put together. So again, in the fund, we're going to go out and acquire real estate. We know that we're acquiring Nicholas and Oliver. If you're in the fund, you definitely have an ownership stake in that. The rest of the dollars, we don't yet know what we're acquiring. So all we can tell you about is what we've done in the past.
And from a legal compliance issue perspective, I need to advise you that we are showing you the actual outcomes for every large multifamily deal we've done where we pulled in investor capital with a similar arrangement to what's proposed in this fund. So we're giving you our historical actual outcomes from which we would have the most ready point of comparison. And you'll see that some of them have better outcomes than others, but this is 100% of that data set of our track record that is directly comparable to what is going to occur in the fund.
So we purchased new 52 for 9.9 million. This is an 83 unit 2016 build. This is on the north side of Rochester. The appraised value at closing was 10.7 million. We worked on this deal for probably about 6 months with the broker, eked out another buyer who was at 9.8, but was kind of dragging their feet and that sort of thing. We said, no, we'll come in at 9.9 if that gets the deal done. So we closed with a little under $1 million in equity on day one. The building was about 30% vacant when we acquired it. Our leasing team filled it within about 6 weeks. And because of that, and also some rent bumps, our projected value at 12 months will be about $12 million. So this is one of the opportunities where we project that we should be able to do a cash out refi in maybe as little as 12 or 18 months. We can't quite hit like that 12-month mark because the bank's going to want to see those books season a little bit longer, but this will be a quick return of capital. This one did have an elevated risk profile because the building was about 30% vacant. The previous property manager had just really let their foot off the gas, really wasn't interested in managing the asset well. We felt very confident because we own that property management company. We can talk to our leasing staff every day to say, what calls are you getting? What's happening? What prices are you hearing? That we could fill it. And that's exactly what we did. That big bump happened right at first because of filling the asset. And then the long-term appreciation will be a little subtler, a little smaller, but this asset should continue to appreciate quite a bit. The area surrounding it, in the front of it, is going to be a senior living center, an assisted living center. The city is actually connecting the main highway to another exit, so it's going to really increase the access to this building. And then in the back of it, the city is putting in a public park with like bike trails. So there is some long-term appreciation potential as the area improves around it. And this is one where we're targeting like that 12 to maybe 18-month period for the cash out refi.
So this is an out of the park home run type deal. When we bought it, the building had never been full since it was built ever. And so we're like, is there something wrong with this building? Is it cursed or something like that? Even the lender kind of confessed that he was like, yeah, we don't know what the issue is with this asset. It's a beautiful new asset. Why hasn't it ever been full? And so it did have an elevated risk profile. And, it turned out that we made $1 million on the day of closing. And we'll make another $1 million here in the next 12 months. So, again, we're not saying that this is going to be the outcome. This will be the outcome for the private equity fund. We're going through each of the direct comparable assets that, would potentially be reflective of what performance could be in the future.
Let's talk about Garden Court West. So this one is in Tacoma, Washington. The funds, the capital in this fund will be spent in Rochester, Minnesota. But this is an example of the type of deal that we're able to put together. We purchased this one for 9.8 million, 64 units, a little bit higher per unit cost because Tacoma is a more expensive market. 1965 construction. The value of the appraisal at closing was 11.8 million,
which is off the charts.
Quite honestly, higher than we thought. This picture shows a beautiful courtyard, beautiful outside exteriors. The interiors of the units were in very, very poor condition. Again, a property management company that really wasn't focusing on keeping this asset nice, attracting high quality tenants and operating it well. But the area around it was doing very well. New Trader Joe's, new Starbucks, new library, new transportation hub. That's why it appraised so well. That's why we targeted this asset. We are going to do a huge construction project. We're about 5 months into that construction project, about $1.4 million in construction. Our as is completed appraisal already is over 15 million, close to 16 million. It's going to take a few years to actually complete all of that construction. So we think that by the time we actually refinance this thing, it might be closer to 18 or 19 million. We're kind of have a target of 20 million. I don't know if we'll quite get there, but that's what we're hoping for. We've increased the rents. There was, quite frankly, a lot of fraud, sort of friends and family of the property manager living there, those sorts of things. Cleared out all of that situation. We're renovating those units and really making this the community that the surrounding community needs and wants. We'll have about 100% rate of return in year one. And this is another where we expect that we might have a full cash out refi in year one. There will be another cash out refi when we complete construction in several years. But because we purchased the asset with so much equity right from day one and have already increased the value even more, we're working with the bank on a cash out refi. And we actually negotiated that with the bank before ever closing to say, hey, this is our plan. And we know we're getting a very good deal on this. And we know that it's going to appraise above value. We know that we're going to increase the value very quickly. So we got their approval for the very quick cash out refi before we ever closed on it. So that's something that we were able to do to increase the certainty that we can pull capital out of this as quickly as possible. So again, the things I'll call out is this is a different market. This deal has even exceeded our expectations.
Yeah, this is ridiculous. We've struggled to renovate units because tenants won't leave even despite rent escalations.
But these are the types of deals that we're putting together that will be in the fund.
So this is a deal that's going to be kind of similar to Nicholas. This is a yield play. So a stark contrast from the two value add plays that we just looked at. We were able to purchase this Class A urban core asset. This is right down the street from Nicholas here in Rochester, Minnesota for $3.7 million. This was the value it appraised for in April 2020. And I don't think you have to be a real estate expert to know that real estate's worth a little bit more today than it was worth in April 2020. So I'm very pleased with where we ended up on our purchase price for that building. We were able to negotiate a $200,000 seller carry on top of an 80% LTV loan. So we're able to buy this new construction Class A urban core asset for about $500,000. Just an unbelievably small amount of money.
About 600.
Yeah, well, yeah, include closing costs and everything. It was 520,000 or something was our down payment. So just a ridiculously good yield play. We're not going to be in a hurry to refi this asset because our terms are so good out of the gate. We're not in a hurry to repay that it's a no interest, no payment seller carry for up to 5 years. Well, we like no interest loans, and especially when they bring down our down payment with the bank. So we're not in a big hurry to refinance that particular asset, but it'll have excellent returns. And we're going to be unbelievably excited that we own that asset, 5 or 10 years from now. Let's take a look at our next example.
And the investors of the lofts are here with us tonight. So thank you so much for being here.
Yeah.
Let's talk about Midtown.
Yeah.
So Midtown is a little bit outside of that destination medical center area.
It looks like we just broke 9 million.
We did just break 9 million. That's why I was smiling so big.
Telethon or something like that. 1 million to go.
1 million to go. I was smiling because I was thinking of our investors in lofts, and then also because we broke 9 million. Yeah. So Midtown is a little bit outside of the destination medical center area. We knew that the main road going to Midtown is undergoing a huge renovation, like a $40 million renovation. That's Broadway in Rochester. We purchased this for $2.6 million, so much smaller purchase price. This will be an example of kind of one of those smaller, medium multifamily communities that will go into the fund. Only 32 units, 1968 construction, got a little bit of equity at the appraisal, 2.7 million, extraordinarily low per unit purchase price of 81,000, multiple other offers. This one was taken to market by a trust. It had a pretty savvy listing agent that really worked hard to solicit multiple offers, and we were able to beat them out basically based on the simplicity of our offer.
I was talking to one of our lenders, and he said that he hasn't seen a multifamily deal that his bank has done this year for less than 100K per unit. And we have done 4 deals this year for less than 100K per unit in our area, which is so all of the most affordable per unit deals have been our deals.
And we often beat out higher purchase price based on our reputation, our certainty of close, and our simplicity. At the time of closing, the rental rates here were the lowest 2-bedroom rental rates of anywhere in Rochester. We've escalated rents to $950 per month before renovations. Because this was built in 1968, the units are actually very, very large and people want to live in them. And now that Broadway has improved so much, the area is improving as well. We plan a very lengthy renovation here. This one might take 2 to maybe even 4 years. You might ask yourself, why is that? It's only 32 units. There's a number of things there in terms of making sure we're managing capital well. So we have one partner in this deal and need to make sure we're managing capital well amongst that very small partnership group. We want to time renovations with the improvements that the city is doing to the area around it. And then most importantly, there are many folks that have been living in this community for 5 years, 10 years, 20 years. And we want to be very respectful to them.
40 years?
40 years.
What,
We don't just want to
40 years?
we don't just want to come in and do a 60-day notice to vacate. So
Yeah.
we will renovate this as the units vacate. And we will, we're in discussions with those folks of, hey, a year from now or 2 years from now, we're going to need to vacate your unit. We're working with some of the folks on like getting into assisted living, those sorts of things.
They need mental health care assistance,
Yeah.
working with social workers. Really, we bought a class C building that was in impeccable condition, that has kind of a class D tenant base. We don't typically do class D, and we're going to need to kind of turn over tenants really carefully, really gently, really respectfully to get up to like a class B minus tenant base. And then we can really renovate those units up to class B units. And you can't just take a class D community and turn it into a class B community in a year. It's just not possible. A tenant comes in for a showing and they see a bunch of class D vehicles in the parking lot, they're not going to rent. It's just not how it works. And we try to be really conscious of the impact that we have on society. A lot of people that could be potentially displaced if we have a heavy hand in this process, and we just try to be as sensitive as we can with that, even if that's not necessarily the best financial outcome. Like, we probably could try to just kick everyone out really quickly, but like that's just not the right thing to do.
So this is one that we might target more like a 4-year cash out refi on this one. We do think that we could double the value of that asset, just because there's so much room there to go on that one. Let's talk next about Uptown Landing and Uptown Terrace. These are both in that Destination Medical Center area, that downtown campus. Purchase price of $5.1 million for the two buildings combined. It was from the same seller to us as the same buyer. 41 total units, 1962 construction. We were able to negotiate $150,000 in a seller paid escrow at closing. We were then actually able to negotiate with the bank of, hey, we've worked with you so many times, we're trustworthy. Can we just not put that into escrow so that we can spend it on renovations more quickly? They approved that.
So we ended up with close to a 90% LTV loan on that particular property.
Yeah. So we're working with a general contractor, Key Builders. That's the group that's building our townhomes, Stonehaven and Byron, to do a very exhaustive renovation of both of these buildings. Lots of permits, structural, electrical, very, very deep value add. We got an additional $400,000 in construction financing from the bank on a very favorable interest only.
I think they want to give us $700,000.
They want to give us like 700, and we're like, wow.
Because the upside potential is so huge. They're like, yeah, we could go all the way up to 700. No, we don't need that much to get the job done.
Yeah. About half of the units across the two buildings were renovated prior to closing. And we really liked that because that proved that they were able to get the rents that they said they were able to. And so we're actually working with the previous owner who did the renovations to source all the same cabinets, all the same countertops, so that when our renovation is done, these buildings look like new construction, and it all has the same feel. We don't have, brown cabinets in this one and white cabinets in that one. 20% vacant at closing. All of the units that were vacant were either rented or are in our renovation pipeline with our builder within a week of closing. So we lined up these things in advance so that permits could be pulled and renovations could start as quickly as possible. And then we're heading toward a 30% rent increase from our renovations there. This might be one that takes, let's say, 3 years for a cash out refi on those.
Let's take a look at a single family home. So again, our ideal mix for the fund is going to be Nicholas and Oliver, like a huge, cornerstone asset, then probably some similar medium-sized properties like the ones that we've just seen here. And then we'll be rounded out with some single family homes as well. So again, from an SEC compliance perspective, what we've done here is we've compiled some information on our personal portfolio of properties and their actual outcomes in order to, again, say that, past performance does not necessarily indicate future outcomes, but this is what our track record looks like. And these are the type of assets and the type of business plan that will be implemented in the fund. So our personal portfolio, we have over 60 properties. We have $0 of cash in the entire portfolio. So it's a considerable portfolio, and we've been able to successfully BRRRR out of the entire portfolio, refi out of the entire portfolio, over 15 million in assets of this portfolio of single family homes that we've BRRRRed out of. We've principally done that in 2 years. So we have been investing for quite some time, but we really blew up our portfolio here just in the last couple of years. So that might give you some sort of indication of what a potential timeline could look like for the private equity fund. Our average time to a full cash out refi is less than 2 years on a typical home in that portfolio. Many of these properties, it was like a 90-day cash out refi type thing. Now it's harder to buy distressed properties and refi and get an immediate cash out these days. Labor and material prices are higher, prices price are higher, but we were able to achieve an extraordinarily fast return of capital on many of these individual properties.
Single family homes go faster.
Yeah.
They're smaller. It's a smaller renovation. They often don't involve, things like permits and those sorts of things because it's more cosmetic improvements. So the fund owning both multifamily that will take some time to do improvements there, and then also owning a portfolio of single family homes that will allow the capital to move faster is how we're able to get those blended returns.
Yep. So again, this might sound a little bit implausible almost, but we've built this portfolio principally in a couple of years. We have no cash in it. It kicked out $300K of cash flow last year. And in cash flow appreciation and debt pay down, it made approximately $2 million. So these are the kind of outcomes that we expect to bring to the private equity fund. We're basically going to be running the fund identically to how we've run our personal portfolio. And this gives you some sort of expectation of what could potentially happen within the private equity fund.
All right, let's talk about the Nicholas.
A lot of compliance stuff to get out of the way here.
Yeah.
Sorry for the long run time here, folks.
So the Nicholas is an asset that we have been eyeing for about 5 years. It's a handsome, gorgeous asset, literally on the doors of the Mayo Clinic, built by the builder who's building our townhomes, owned by an amazing family in town that has managed it themselves. And the entire time they owned it, was built in October of 2015, which is very near and dear to us. That's when we had our first child. So it's named Nicholas. It was born the month and year of our first child. We cannot describe to you how excited we are, what a high quality asset this is. Of course, we're a little bit biased, but I think we estimate this is probably the 5th or 6th nicest multifamily community in Rochester. And the ones that are nicer are hundreds of millions of dollars. Those are our 10-year goals. So let's dive into the Nicholas.
There's one question I wanted to touch on very briefly there. Someone said it looks like you're going to be fully subscribed tonight, so maybe not worth for newbies to stay on and wait for the recording. I can, we've got a little dashboard here from our portal, so I can see that some people have signed in and indicated an amount they might want to invest. Some people have completed all the paperwork already. Some people have initiated the funds transfer. So this is a first come, first served basis offering. So I'd encourage you to jump into the portal. And if you do decide to, sign the paperwork and remit funds ahead of someone else, that's how the commitments are honored. So it's very much worth your time to hang out and commit if you decide that you want to. So I just wanted to call that out.
And I'll be hopelessly transparent. We've been through this process many times where we will do much smaller raises and they'll fill that same night. We really thought that the fund would take a month. I mean, you guys are literally like bringing me to tears that we're going to fill this thing tonight.
There's hope for capitalism.
And what I've told people in the past is the time and the effort that you spend learning about this will yield dividends in the future, because the folks that are making commitments tonight are the folks that have listened to us in the past, that see that this fund is 95% similar to all the other deals we've done. And so I hope that the education and the relationship that we're building, that allows you to feel more confident more quickly investing in a future fund. I think it's very likely we'll have Fund 2 launched in maybe 8 or 10 months. And so the relationship is the most important thing. And we value your time. We appreciate your time. You're hanging with us late at night here, coming to other webinars, reading our emails, those sorts of things. And really encourage you to think of it as a relationship building exercise, and get in on Fund 1 if you want to. If not, Fund 2 will definitely be coming in 2022.
I do think that Fund 1 is special with the Nicholas. We really wanted to do the Nicholas on our own. It would have been a stretch for us to come up with the 2.3 million in liquidity, 2.4 million in liquidity. We could have maybe just barely done it. But just from like a spiritual perspective, it was so tempting to do the deal on our own. And it's going to be just such a very financially lucrative deal, in addition to kind of the spirituality to it. And then we realized that this was the opportunity to really take things to the next level, and would be the perfect cornerstone for our first private equity fund. And it's such a ridiculously good deal, honestly, that I hope it gives people an easy decision to make. And as much as we'd like to own this property by ourselves, we also see the value in kind of stepping up our game and going to a private equity fund model. So we're kind of we're seeding that with a ridiculously good deal, essentially.
Let's talk about the qualitative aspects
Yeah.
of the Nicholas. So this is what we would consider to be a dynasty asset, extremely high quality construction, all brick, the most sophisticated HVAC system you could possibly imagine, with parts flown in from Europe on the steps of the Mayo Clinic. 2015 build. Nicholas is in the front, Oliver's in the back. Oliver's a smaller building, Nicholas is the bigger building, but they're connected. So from the street, it looks like they're not connected, but they are connected.
Really carefully architected buildings to conform to the neighborhood. Like it ambushes you. Some of the investors on this call have come to visit us, and we've taken them by Nicholas, saying, "Hey, we're going to own that thing one day, we promise." And you walk right up to it, all of a sudden you turn around and you're in a residential neighborhood, and you realize there's just this massive, handsome building that looks almost kind of indistinguishable from the neighborhood around it. The different buildings have different architectural characteristics. There's a monstrous underground heated parking structure, but it's kind of tucked in behind some landscaping around the side of the building. It's the opposite of kind of this pencil high rise or something like that. It fits in so perfectly with the neighborhood. And it's a historic neighborhood. This is a neighborhood where you can't knock down buildings to build. You have to pick up and move buildings to build. They had to relocate buildings in order to build Nicholas due to the historical significance of the buildings that they were displacing. So the location to this property, is difficult to articulate how desirable it is.
$23 million purchase price for the Nicholas and Oliver. The deal that we've been able to negotiate with the sellers and the bank, I don't want to say it's the best deal of our lives, because I think just as we get better and better, hopefully we're upping our game, but certainly this is, it defies the imagination what we've been able to negotiate. We worked on this for about 8 months with the seller and the bank. So we are taking over an $11.5 million loan. The bank has approved all of that. We're all ready to go. You might be asking, like,
90% approved. Yeah.
You might be asking, like, well, how did you get that asset under contract like 10 days ago and you're closing by the end of the year? It's because of this, because we've worked with the seller, we've worked with the bank, this financing that we've arranged here. 7-year term, 4.5% interest rate. That's the not so great part, 25-year amortization. The reason we're taking over that loan is there's a swap, which is a prepayment penalty against that interest rate. And so because the bank knows us and we have many other loans with them, they're willing to allow us to assume that loan. And then that saves the seller that pretty hefty prepayment penalty. And so we needed to negotiate something there to make that favorable to us as well. The thing that we negotiated there, there's actually a little bit of a typo here. So we wrote $11.5 million seller carry. It's actually about $9 million.
$2.3 million down on the $11.5 million.
Yeah. So a $9 million seller carry for 7 years with no interest, no payments. If there are any legal beagles in the room, you might be saying, well, the IRS doesn't allow no interest payments. The IRS does what's called imputed interest. The seller is aware of that. They're going to pay that tax burden themselves. This was what they wanted, because they wanted our family to take over their family's legacy. And this was the way to make it happen. $2.3 million down payment. So a 10% down payment instead of a 20 or 25% down payment. That's what is allowing us to acquire this asset with very little capital. It's about a 90% LTV. When you blend these kind of multiple pieces of financing together, 90% LTV, about a 2.5% interest rate overall, and a 45-year amortization, again, when everything's blended together. It mitigates that prepayment penalty. We're working with the bank, green light all the way. No origination costs, no lender costs, no appraisals. Our closing costs on this thing might be $50,000. The attorney's like, you messed up on the closing costs. We're like, nope. Closing costs are just that low. So just driving efficiencies as much as we can, because if we can lower closing costs, then that's money that gets back into your pockets more quickly. And the targeted closing date for this is December 28th. We already have our cost segregation scheduled. We'll do bonus depreciation, yield tremendous tax advantages in the first year. So it was a little scary when they called at the beginning of December and said, we're ready to sign. Are you ready to go by the end of the year? We said, well, that'll be a challenge, but we're going to make it happen. And we have a group behind us that can make that happen. We are over 10 million.
Yep. And again, it's a first come, first serve basis. Yep. So please log into the portal, make your commit, start the funds transfer process if you do want to get involved. So why would the seller agree to this deal? Why is this a win-win deal? We only do win-win deals. In fact, I think someone just asked that question. So the seller would have had to pay $1.5 million in a prepayment penalty if we just made a clean offer and did not assume their financing. And we are assuming a kind of crappy loan, right? That's at a 4.5% interest rate on a dynasty asset like this. You can, with interest rates being what they are, we could probably get, a 3.0% interest rate or something like that. And so we were able to get them to agree to kind of like a no interest, no payments carry for that difference. And then that blends together to be a really favorable loan term for us, exceptionally favorable. And then they end up getting a higher top line number, a higher net number, because they're willing to do this no interest, no payments loan. Now, let's say we were hypothetically able to drive huge value to this asset, and we did a refi 3 years from now. They'd come out way ahead on kind of that imputed interest versus paying that $1.5 million prepayment penalty today. If we let that loan go for 7 years, maybe they came out behind on that deal, and we're not going to be in a hurry to repay a 7-year no interest, no payment loan either. So that's how this is a win-win deal. We are saving them $1.5 million in immediate hard cost by assuming their kind of unfavorable loan that's already in place. And in exchange, we're getting that trade-off of that really favorable seller carry.
I'm sure numbers are super important to folks. I saw one of the questions was, how are we targeting this 50% total annualized rate of return in the first year? So we want to share that.
And this is in the portal. There's an Excel spreadsheet in the portal that has all these numbers. And again, we have a recording.
So I made that a little bit bigger. Those of you that have seen our other deals or have done our course recognize our pro forma. We try to keep a really simple pro forma for everything so that we can analyze things in hundreds of different scenarios. And these are kind of the averages that we're putting together. A big part of how we're able to get to a 50% total annualized rate of return in the first year is that the down payment is so low. So what we typically target in a real estate deal is at least a 25% total annualized rate of return. That's something we look for time and time again, but that's assuming like a 20 or 25% down. When you slash the amount down in half, well, that doubles the total annualized rate of return. So if like just a quick, like, how are you getting to 50%? That's how. And then here's the numbers. Income for the asset should be about 1.8 million. We have our expenses there, things like insurance, taxes, maintenance, property management, all of those things. Our debt service is about 900,000, which will yield cash flow of about 175,000. So about a 7% cash on cash rate of return. Certainly not like just a slam dunk, hit it out of the park, but about what we see and about the deals that we've put together over the last several years. And then
sorry for the confusion there. So this is the actual spreadsheet that goes with the fund. So I want to make sure we're presenting, from like an SEC perspective, the exact.
Got it.
You had pulled up a different similar spreadsheet. So the numbers are almost identical there. I just want to make sure we're being totally compliant here.
Got it. Yep. You can see like the 1.8 million in income, our debt service of 900,000, our expenses, NOI of a little over $1 million, cash on cash of about 7%, and then a total annualized rate of return factoring in cash flow, debt pay down, pretty favorable debt pay down because it's 25-year AM, so it'll chew up that loan pretty quickly. And then targeted appreciation of over 50% in year one. In just a few years, we're projecting over a 60% total annualized rate of return. And the cash flow will go up as well. So those are the pro formas. They are in the deal room as well. But I wanted to make sure we shared those. We of course can't share any other pro formas for the fund because we don't have those properties identified or under contract. But since we are under contract on this one and have really crunched the numbers, really looked at our business plan, we're able to share those. And then we're also able to share pro formas from properties that we currently own. And that's, that I would say that's even more valuable data, because there's more certainty that we actually own these assets, we're operating them, we're getting historical financials. And so you're able to see those as well. And you're able to see how we get to that infinite rate of return. And that's the real target. How quickly can we get there? And then how much can we produce after that?
And in Nicholas, you might say, hey, isn't this negative cash flow? That's exactly right. We wouldn't be buying something if there wasn't an opportunity for improvement. And the seller is certainly struggling a little bit with their current management situation. So for example, when the asset was constructed, they installed a really expensive and sophisticated system to track HVAC therm utilization on a per unit basis. And it's a sophisticated hardware and software system that can plug into your property management software and bill back to tenants for their heating and cooling utilization. They have never turned on that system. Just they don't want to hassle with it or something to that effect. I don't know. There's lots of long-term residents in the building that just love living there. There's been no rent escalations. There's numerous tenants that are actually still paying the same rent they were paying when they moved in after the building was built in 2015. So no rent escalations whatsoever in that time period.
We can't say enough good things about this family and the legacy that they have created.
Taking amazing care of the building. There's two maintenance tickets on the whole building outstanding right now.
And even before that, this family has owned that land for like 30 or 40 years. They moved these buildings. They did so in such a special way, where they took some of the stained glass from those buildings and actually incorporated it into Nicholas, to give you some sense of how they think about legacy and dynasty. But they're not professional property managers. This is the only building they've ever managed. Could you imagine going from not managing any real estate to managing a 95 unit on the doors of the Mayo Clinic? And so we're able to take the legacy that they've created, take this extremely high quality building, bring into it our professional management, the outcomes that we've created with other similar buildings right, in that same street. Go back and look at that map to get some sense of how on top of each other all of these buildings are, to really drive value. So taking something that's really valuable and making it even more valuable.
Absolutely. So we're very spiritually excited about doing this deal. We really love the seller of the family. Can't make this up. We're doing our unit tours on Monday, and they're talking about how they have this like little hobby farm, and they're talking about how they have like goats and chickens and ducks. And they said, oh yeah, we're really proud of it. We even have a mating pair of 2 black swans. And I'm like, whoa. There's like 10 people there. We like stopped the tour. I'm like, you have actual living black swans. And they're like, yeah, but Elaine and I actually only seen our first black swan in our whole life in Hawaii a month ago.
Yeah, like 6 weeks ago.
They're not a common thing to see in this part of the world. You have to import them. And so they just happen to own they have to be the only people in Rochester, maybe the only people in Minnesota that would have, black swans. And
we're like hatching up a plant hatching. We're hatching up a plan. So we don't have the lakes and the infrastructure that we did, but we have a tiny little 2-acre piece of land. And we're like, can we have one of your cygnets this spring? Maybe it can live here in the summer and then live there in the winter, because they have the infrastructure. We believe in these things. We believe that Nicholas was named Nicholas and born in October 2015. And we have this great relationship with the sellers, this great relationship with the builder. And they own black swans. Like,
it's just meant to be.
That's what keeps this interesting for us. That's the end of the official presentation. Let's jump into questions. Riley and Rebecca, you did an amazing job kind of compiling them.
We got a lot of questions.
Where are our questions? You kind of moved some things.
They would have been over here. Oh, there they are. Stop the screen share for now.
Okay.
We'll need to kind of triage these a little bit.
Okay. Are you going to batch fund properties in the same state? Yes, for Fund 1, everything will be purchased in Southeast Minnesota, in Rochester, Byron, Pine Island, some of the other smaller communities around here. I wouldn't be surprised if everything is right here in Rochester.
Yep.
How much debt versus equity are we using to buy and rehab these properties? So we talked very specifically about Nicholas, about the very favorable debt terms we were able to get on that. In general, you can think of every property will have like an 80 or 75% LTV or loan to value. And then we work with the bank if we're able to get construction financing, if we're able to get things like an interest only period to increase cash flow during that period of renovations. But in general, about 75 to 80% LTV. If we're able to negotiate a seller carry, that's always very favorable because it decreases the amount of capital that needs to go into any given deal. You saw that we did that on the lofts, for example, and then that allows us to acquire more real estate with this same bucket of dollars to drive more profitability overall.
Yep.
Excellent questions there. Nick, I'll let you grab the next couple of questions.
What do we got here? Will there be opportunities to invest in the fund later or in fund two? So, we've talked a little bit about, the soft commits versus hard commits, remitting funds. So it's first come, first serve. There will almost certainly be a fund two. We'll see how fund one goes. So it's off to a great start so far. We're very excited about, fund two already. We don't want to say when that might happen. So let's say hypothetically, so we're going to do one big reason why we want to do a fund, by the way, is as we have acquired more assets, we've started interfacing with more and more sophisticated sellers. And basically when we talk to them on the phone, the first thing they say is, why are we talking on the phone? We'll say, well, because we want to buy what you own. And they'll say, yeah, but you're not a fund. Like that, it just doesn't compute that we'd be able to put together like a joint venture partnership, that could go buy a $30 million asset. We can, but that's such an unusual thing that it doesn't really compute with brokers and sellers. So we kind of have to have a fund in order to have credibility to go buy a $50 or $100 million asset. So the first thing we're going to do is take our proof of funds with $10 million in it and send it to every commercial broker in the area and say, hey, what do you really have for sale? And it's going to open a lot of doors and allow us to have a kind of buying power and get a kind of cash discount that we were not able to get before. So it's possible we could go purchase, say, a $50 million asset or something like that out of the gate with fund one and wrap that fund out in short order. And then fund two would come in quick succession. Or it might take a long time for us to find really amazing deals that we're excited about. And maybe we spend the whole year placing capital in fund one. And so it takes a while for fund two to come along. It's a common incentive that's offered in funds to offer some sort of rate of return on capital that's not yet deployed. We very deliberately don't do that because as an investor, you should ask yourself, if you really want your money burning a hole in someone else's pocket, you probably don't want them super incentivized to deploy your capital faster than they want to. We're going to make sure that we're buying really amazing deals with this fund.
Mike Wynn said, did anyone lose audio? Mike, Rebecca, Stephanie, you guys can hear us. Riley. Okay.
Sorry, Mike.
Mike, I hope you come back. Suzanne asked, how will you decide what single family homes you'll offer to investors versus those that will go in the fund? So let me give it just a tiny bit of background for those that maybe haven't worked with us before. Over the last several years, one of our main investment offerings has been helping individuals purchase single family homes here in Rochester, and then we manage them. Over time, we've learned that we have hundreds of buyers that want to purchase single family homes. We'll send out an email. The home will get snatched up in literally a minute or two. And the person that emails at minute 5 just can't believe that the home is already taken. And that pains us. We know that people want to be involved and we're not able to serve as many investors as we would like to. And then we've also learned that investors aren't really looking for, oh, I want to go buy 123 Main Street. They're saying, whatever deal you think of next, whatever deal is in your pipeline, that's the one we want.
That's right.
And so with the fund, we're able to do that. And then the third thing is, particularly with single family homes, we know from managing hundreds of them that it's just like population health. It's just like human health. So if there's 100 homes, 95 of them have an amazing year, no vacancy, has a nice rental increase, maintenance is low. And then there's a few that maybe there's some vacancy or a kind of an unexpected maintenance thing. Like,
we have one house that we put a new roof on it this summer. And then of course, as soon as the cold hits, we're putting a new furnace in it.
Yeah.
Like that. It just, of course, that happened to that one poor house.
Yep. Let's say a water heater lasts 10 to 20 years. Well, it's great if you can get to the 20 years, but some of them go out at 10, some of them go out at 7. And it's no fun to make that phone call to that person. Oh yeah, your water heater's only 7 years old, but it needs to be replaced. And in the fund that blends all of that together. So everyone will own all of the real estate together, and those risks and costs will be smoothed. And then the upside is also smoothed as well. So some properties are just rock stars. They just perform time and time and time again. Obviously, we work really hard to try to identify those, but some of them, it's just you get a great tenant in there that stays for years and years and just maintained really well. And so for now, our focus will be on deploying all of the capital in the fund. We did send out a private email to the folks who have already owned single family homes with us. Rest assured that we're going to continue to manage those. We're going to continue to love them.
Nothing changes whatsoever for any of our management clients.
Yep, nothing changes there whatsoever. But new acquisitions going forward will be in the fund structure. So if you like what we've created in the single family home portfolio and you like those outcomes, participate in the fund so that you can continue to get those outcomes blended across all of the pieces of real estate. What's the local market like in Rochester? Job growth besides Mayo? Read about Destination Medical Center. It is a fascinating study in community planning, in public-private partnerships. It is the largest per capita investment anywhere in the country, right? So things like Memphis or Phoenix or other cities kind of get all of the attention. Meanwhile, there's a rather small town in Minnesota that has the largest per capita spend on infrastructure anywhere in the country. Google is here, Apple is here, IBM is here, lots of other companies that maybe aren't household names, but are really moving the needle forward in technology, biotech, genetics, medicine.
Rochester is home to what was once the largest office building in the world in the mid 1990s, or for decades it held the title. Now there's some building in China that's a lot bigger. So that was one of IBM's primary campuses, and that's now a mixed use tech space or something like that. Certainly the Mayo Clinic is the principal driver for Rochester, but there's lots of other things going on. It's a fantastic market. We could spend a lot of time talking about how much we love Rochester, but suffice to say it's a very strong community.
Have returns and cash flow been estimated if interest rates double? So I wouldn't say yes to that exact question, but we think about interest rates every single day. Nick listens to several podcasts that are just about interest rates literally every single day.
Yeah.
So part of the business plan is that cash out refi. So we're watching interest rates. And if we think that an interest rate bump is coming, we're going to work really hard to refi before that happens. Or if that interest rate bump comes, then find a different way to drive profitability in the business plan, whether that's through further renovations or just holding the debt and allowing the cash flow to be the producer there. When we look ahead, again, just for SEC compliance, we don't have any crystal ball for interest rates, any more than any of you do here. But when we look ahead, we see a period of low interest rates for the foreseeable future. The government's working hard to minimize inflation, to stabilize things through COVID, through the variants, through all of the changes in employment and those sorts of things. The Fed sends signals before interest rate changes happen. So it's not like we'll wake up one day and have a planned refi 3 months from now and oops, interest rates have doubled. We'll know well in advance if that's happening, but it is something we think about. Absolutely.
From a track record perspective on our single family profit, our single family product, we sent out a lot of messaging to our ecosystem in February that interest rates were about to spike in a massive way for conventional loans for our single family home buyers. And they did in April. That's because we pay attention to Fannie Freddie guidelines and the steering that they provide. We predicted that when Fannie Freddie pulled out of that market, there'd be a huge spike in interest rates. And then after about 6 months, a lot of secondary players would enter the markets to pick up that gap in the market and start buying those mortgages, and those rates would go down. And eventually it's possible there could be an even better mortgage market for investment buyers. And that's exactly what happened. It's not like we're geniuses or anything. listen to people who are a lot smarter than us and think critically about what they have to say. And I would say we predicted within like a tenth of a point, basically, where interest rates were going to go over the next 6 to 9 months in that specific scenario. We don't have a crystal ball. Who knows what happens, but we do have some pretty accurate guesses about the future, because interest rates do have a big impact on our business model. And we feel like we're making a really good educated guess and building a good business plan around that.
One of the things I want to mention is one of the things we've been able to do in the single family home space is purchase with cash, do the renovations, and then do the cash out refi. And because of the way lending works, you can do that very quickly in, say, 90 days. That's not been possible for us in the multifamily space, because while we have been able to bring in partners that can bring large amounts of liquidity, we've not yet been able to buy a $10 million apartment building with cash. But with the fund,
we can now.
We can. Well, not quite 10, because we've got Nicholas earmarked,
Yeah.
but we can go buy, let's say that, for example, Uptown Landing, that was $5 million. We could purchase it with cash, do the renovations, and then instead of targeting, like, let's say a 2 or 2.5 or 3 year cash out refi, we can drive those renovations even faster, because we're not tied to the previous bank debt and to the previous appraisal. And we might be able to do a cash out refi in 12 months or 18 months, or, if it's improving the management and it's not so much the physical renovations, maybe we can do the cash out refi in 6 months. Again, I'm not saying that definitively will happen. We've not done that before. I want to be very clear about that, but we've done it in the single family space. I don't know, 80 times, 100 times.
Yep.
And so we know that business model works, and the fund will open us up to that opportunity. And the reason I mention it with that question is that the faster we can recycle this capital, the better that is for everyone. It prevents, it kind of shields us against the interest rate escalation risks. It gets the capital back to you. And by being able to purchase with cash, we can move faster. So that's something I want to mention there too.
Do we invest and own a piece of the real estate, or do we just invest in the fund that invests in the real estate? Excellent question. So there's nothing terribly magical about a private equity fund. I feel like a lot of people, they like to say, oh, I am a fund manager, I have a private equity fund. It's an LLC, and you are a member of that LLC, and that LLC is going to own a bunch of real estate. This is as complicated as it gets. It's really not that different from our joint venture partnerships, except there's going to be a lot more partners, and we have a whole bunch of SEC compliance kind of stuff that we want to make sure we're staying very compliant with the law. But at the end of the day, you're going to put your money into an LLC, and that LLC is going to buy a bunch of real estate. So it is different than like taking title in your personal name to a single family home or an apartment building if you were to take title in your own personal name. Although most investors would tell you it's probably better to own the asset in an entity, and then you own the entity, and maybe you have some partners in the entity, or joint venture partnerships. Maybe we have a few partners in those partnerships. So I guess it's a little subjective, or it's a matter of opinion on how real or different those types of ownership are. I think that owning a single family home in your own personal name is a beautiful thing, and we have a whole course that we give away for free because we really worship the spiritual ownership of the thing. We also think that a private equity fund creates huge economies of scale and efficiencies, and opens up opportunities that just aren't available without having a vehicle like that. And so that's why we're offering this fund as well.
I'm going to jump down. So if we invest in the fund, how do we get the tax benefits? So things like depreciation. So all of the tax filings will be on a K1, and that allows investors to fully participate in all of the tax advantages. So I hope that answers the question. If it doesn't, schedule a one-on-one call with us so we can address that. But just that's how the tax filings work. And then I also want to address, will we get a K1 for this year? Yes. So that's one of the really interesting things about putting money into a fund in the middle of December of 2021 that's going to close on an asset on December 28th. It will be an extraordinarily large amount of bonus depreciation because of the relatively small down payment that's going into the Nicholas and Oliver. So people will be able to participate in all of the depreciation this year.
A typical private equity fund, it's a period of months to form the fund and to fill the fund. And then you go out and buy assets after you fill the fund. And we went out and bought an asset with a less than 30-day closing and then built a fund around that asset. So we're going to fill it apparently in a day. There's a whole different kind of velocity to capital that's at work here. It's unheard of that you'd be able to put money into a fund in mid-December and still get huge bonus depreciation for 2021. But that's exactly what's going to happen here.
Can we speak to the pros and cons of holding the fund in a regular account that would be like a checking account, like a post-tax account, versus a tax-deferred account, like a self-directed IRA? So it's really the investor's preference. From a financial perspective, the one difference would be that retirement accounts will not participate in depreciation because they can't do anything with the depreciation. So that would be just sacrificing depreciation into a retirement account at the expense of the other investors in the fund. So really it comes down to, do you want the profit from this to hit your bank account so that you can spend it on your lifestyle, cutting back on work, travel, those sorts of things? Or do you want it to go into a retirement account that has those restrictions on, when you're able to access those funds? But really it's just a personal decision, and there's really no major difference besides that depreciation, which really doesn't have an impact, and then just where you want the funds to go.
We would recommend that you invest from a self-directed retirement account that is exempt from UBIT or UDFI taxes. So a qualified retirement plan, a QRP, or a self-directed 401k, those vehicles would be exempt from those taxes. So would a defined benefit plan. If you don't know what I'm talking about, we can have a short phone call. If you go to eqrp.co, a friend of mine, Damian Lupo, owns that company. That's just a facilitator that helps you with self-directed retirement accounts, and he'll send you a free book if you want to learn about that. But you probably don't want to invest in this opportunity from an IRA, because that would be subject to UBIT and UDFI taxes potentially.
And all capital letters, talk to your own people, your own attorneys, your own CPAs, your own advisors.
Thank you.
That's what we think, we might do if those were our funds, but talk to your own people. Is there an online brochure? Yes, absolutely. So in the deal room is the PowerPoint, the pro formas, everything that we went through today. And that is Black Swan Fund 1, like the number 1.com. And I will put that in chat there. I'm more of a visual person too, so I have an appreciation for that. Thoughts on a 90% LTV? Isn't that traditionally very aggressive? Excellent question. And yes, a traditional loan at a 90% LTV would be very aggressive. I would say, maybe even bordering on reckless. A huge portion of the financing is no interest, no payments for 7 years. Yeah. So it's essentially
it's like a 50% LTV loan if you think about it.
Yeah. So that's what shields from risk. I personally would not invest in a 90% LTV with like traditional bank financing. But because there's no interest, no payments on a huge portion of it, that not only is it not as much risk, it's less risk than even like a typical like 80% LTV loan.
What we look at more than LTV is debt service cover. So, and that's how banks underwrite it, by the way. They don't look at it from an LTV perspective. They look at it from the perspective of, can you pay the mortgage and have enough margin for safety that even if there's a problem, you're still going to be able to pay the mortgage. So as long as we're able to put together a pro forma where we see really safe, comfortable margins, ideally a 1.2 debt service coverage, so 20% more than the debt payment in net operating income. Again, these are underwriting guidelines that the banks like. We like that quite a bit as well.
If this is a long-term hold period, how will leaving the fund happen in future years be handled? So once your capital is returned, there really should be no reason why someone would want to leave the fund, because that's the period where you're getting those infinite rates of return. You're getting those quarterly cash flow distributions. You're participating in equity. But everyone has a different situation. We understand that someone might want to. The first thing we would do is like really talk through and make sure that someone understands that they're ending their period of infinite return.
You're killing the golden goose.
Yeah. There are ways to do that in the operating agreement where you can sell your shares back to the company. You can sell your shares to one of the other investors in the company. You could sell your shares to Nick and I. If you redeemed your shares at the time of a cash out refinance event, you could get your equity and then leave the deal and then not participate after that. So there are ways to do it that, would be rather simple from like a tax and legal perspective. I don't think anyone would really want to, though, because then you're removing the many, many years of the potential infinite return.
And you'll have a tax bill.
You'll have a tax bill
when
because you'll
you
have to
get
do
out.
that.
Yeah.
That depreciation recapture.
Yeah, this is a super common question that we get though. And this is also from like an SEC compliance perspective, we really did have to have an end in the fund. So I saw some questions there. So we have a 15-year call option basically. So you have to hit a minimum 15% total annualized rate of return during the time that you're in the deal. You have money in the deal. And at that point, if you are still in the fund after 15 years, at that point, we could technically have a call option to remove you from the fund. So that's the exit that we have on paper. I don't think we would necessarily exercise that option. And it's entirely likely that these assets could sell in advance of that period. But most funds are like a 5-year fund. And so when we spoke with our attorneys, we're like, okay, what's kind of the longest timeline we can have? And they're like, 10 years. We're like, how about 15 years? And we're gonna promise a kind of ridiculous, like I'd say like a 7 pref or something would be common. So we're gonna promise a 15 pref as like a minimum rate of return for that time period. And at that point, we have an answer to people's questions about what's the end of this thing. And our attorneys are happy that we have some type of finite end date in the fund, but I really don't see us necessarily exercising that call option.
How likely is the deal to close on the Nicholas by the end of the year so that we get tax benefits for 2021? About as certain as we can say. We have the closing date set with the bank, with the title company. Our team is working through things like the rent roll, moving over security deposits, those sorts of things. It's tight, so I don't want to say 100% we're closing. We're closing on the 28th. So that if there's a little bit of a snafu, we have a couple of days there. We are willing to close up to and including December 31st. About as certain as we can be, but
90%
things happen.
Yep.
And then
if we didn't close on it, it's then likely we would close the following year. So it's much less likely that we wouldn't close it all versus just not closing this year.
Yep.
But we would very much so the sellers really want to close this year for tax reasons, and we really want to buy this year for tax reasons. So our incentives are very aligned, and we are all aggressively following up with our attorneys and accountants and making sure that everything's getting done as quickly as possible.
Yep. Does the fund include the Nicholas, or is that a separate fund? Yes, absolutely. Everyone that has any money in the fund is getting an ownership stake in Nicholas and Oliver. The Nicholas and Oliver is what we're calling the cornerstone of the fund. So it'll be about 25% of the capital in the fund is being used to purchase Nicholas, and then the other money in the fund is being used to purchase other assets, like the examples that we gave in the presentation.
Will Black Swan Real Estate participate in the fund as a Class A member as well to any degree? Great question. So we're painfully transparent about this. Our goal is to not have any capital in the deal when we're done, when all is said and done, when we're closed. We shoulder a lot of pursuit costs, a lot of risk. If the deal falls through and those pursuit costs are lost, those are our risks to shoulder. A lot of syndicators will say, yep, I'm putting my own capital in the deal, and then, oh, sorry, there's just so much interest in the deal, I stepped out to create more opportunity for other investors. Or they might take fees and then realize those fees as their cash into the deal. And when all is said and done, I think just about every fund manager syndicator will tell you in private that their goal is to not have any money in the deal. We're very transparent about that, and there's a lot of reasons for that. So we have millions of dollars in liquidity right now. We perceive that to be just a requirement for us to do business with 9 figures of assets under management. And if we leave money in the deal, that really increases our risk profile as a company. So a lot of people try to do no money down deals because they don't have any money to put down. We have very ample reserves of liquidity, but we try really hard to make sure that we continue to have ample reserves of liquidity.
We also don't take any fees. Yep. So we're not taking anything out of the deal right from the start or as we go along. And then we don't profit at all until everyone is paid back. So we will operate this fund for 2, 3, 4, maybe that 5-year time frame, really not getting any profit from it until everyone is paid back. And then in the operating agreement, we say there's no mandatory capital call. There is we have to write into the operating agreement that there is a way to call capital if everything burns down all at once or something like that. It would be our capital that would go in first before we ever pick up the phone and ask someone to put capital in that they didn't plan to put in, right from the get-go here. It would be our own capital that would do that. So that kind of hopefully answers all of that question. Again, very different than kind of a typical model. I would say that we behave more similarly to how other people are behaving. We're just so much more transparent about it that it feels different, but it's actually the way everyone else is doing it. And they're just kind of shielding it behind fees and splits and fancy maneuvers of, oh, well, we got to 10 million, so we just won't participate tonight, versus us just saying, from the get-go that these are our plans. This is how we're aligning incentives. This is how we're protecting you as much as possible. And we're doing it with transparency that we hope really changes capitalism.
Or to say it another way, let's say we put 20% of the capital into each deal, we would not have done very many deals this year. And we would not have been able to create a lot of opportunity for a lot of other investors.
Some of the questions have been answered here about.
Is there any way we can offset non-passive income and lower AGI through the syndication, depreciation, if you will be doing bonus depreciation? So we will be doing bonus depreciation, cost segregation, accelerated depreciation. If you are a real estate professional, you'll potentially have the opportunity to offset non-passive income. But the losses that you'll get from your K1 will be passive losses.
One of the questions was about, how many properties will we be buying? We don't know at this point. As many as possible, as many good deals as we can get. It will be some combination of several smaller properties, or if we can get a large, really high quality property, it would be something like that, but can't quite predict that yet since we don't have anything else under contract right now besides Nicholas and Oliver. We talked about the call option. So that was one of the questions. What is the call option? We just addressed that.
How long
a
is
few
the
minutes
term?
ago.
Yep. How long is the term on the original loan from the bank? So there's June of 2028 is when that note expires. And that's when the seller carry expires as well. So we've timed those two to align. One interesting thing, an artifact of the fact that it's a swap, means that if interest rates go up, we're going to draft a contract here such that we inherit whatever early termination penalty there is from the swap. But if interest rates go up, you can actually even get a refund from a swap. So it's like a reverse prepayment penalty. So there could even be an advantage to prepaying the loan if interest rates did go up. Just a fun. There's a lot of upsides in this deal.
One of the questions that caught my eye, that's a very recent question, I apologize for skipping ahead of everyone else that asked earlier questions, is who is the guarantor on the loan? And the reason I want to answer that kind of in conjunction with kind of how we're structuring the funds in terms of the risk that we ourselves as people are putting into it, is Nick and I are personally signing this loan. This is a full recourse loan with a local regional bank.
We are personally assuming the loan.
Right. So we carry a tremendous amount of risk there, a lot of skin in the game, even though, I hate that phrase. But hopefully that shows you that we really believe in this deal. We're signing a $11 million note. No one else in the partnership group will have to sign on the note at all. And any future debt, it's very likely that we would sign full recourse notes. Some of the debt may be non-recourse. We just need to kind of find what the best debt out there is that we can find. But if there was full recourse notes and someone needed to sign a personal guarantee for anything in this fund, that would fall to Nick and I alone. So very, very good question there. Yep. Let's talk about the real estate commission.
Yeah. Do you get a commission for the sale as a real estate agent? We absolutely do. I like to get up to a 3% commission if I can get it. It's not always a 3% commission. On Nicholas, we're getting a 1.5% commission. That was the most we were able to negotiate. It's very, very advantageous for us to receive a real estate commission versus taking an acquisition fee. With an acquisition fee, the capital partners are basically paying 100% of that fee to the active partner. And we just don't think that's right. Receiving a commission, we're typically able to negotiate that as a split from the listing broker or kind of an additional negotiation term from the seller. And then the bank finances that in this case at essentially like a 90% LTV. So our investors are only shouldering a teeny tiny fraction of that income stream that we have. So we're very transparent that we do need to receive some kind of compensation. The costs to put these deals together are considerable. And that's how we choose to do it. The easy thing to do is to take a fee. It is hard to negotiate a commission in these transactions, but doing the hard thing is frequently the better thing. And we're happy to do the hard thing.
How long will we have to transfer funds? That's a really important question. So the fund is set up as a first come, first serve basis, particularly that we're closing on one of these big assets in less than 20 days.
So if you go to transfer funds and we've already received too many funds, you won't be able to transfer the funds is how that will work. Yeah.
So communicate with us
Yep.
if you're,
Yep.
moving funds around or that sort of thing.
Yep.
Schedule one of those 20-minute calls. I'll actually drop that link here in the chat. We've really tried to clear our calendars over the next several days and into next week for 20-minute calls with Nick or I. So if you're really committed to the fund and you've signed the paperwork and everything, but you need to move money out of a stock account or anything, let us know so that we can, mark that. If we get to a place where, say 10 days from now, something's signed, but we haven't heard from you and the funds aren't received, we're going to remove that to open the fund for other folks. We're at over 11.5 million now. So as soon as possible, but don't feel like you need to just like drop everything and stay up all night to move money around. Just let us know.
And if you are moving around funds to place 100K, we're going to have less flexibility with that than if you're placing $1 million and you can, put 100K down today and, have another 500K before we close on Nicholas, and then the remainder at some, near future date or whatever. Yeah, just communicate with us and we'll make sure that we're able to work with you here.
I want to address this question. It's my understanding that the maximum return an investor can make is 15%. Because after 15 years, the company has a call option to purchase the shares back. So for those of you that haven't looked at the operating agreement yet, you'll see that as the call option in the operating agreement. That's where this question comes from. Let's be very, very clear that that's the minimum that you would receive.
A somewhat ridiculous minimum.
So we could not call your shares and say, oh, by the way, you're getting a 3% return, boo-hoo, we have this call option. If we exercise the call option, we are committed to you having at least a 15% rate of return for the years that your capital was in the deal. It is our expectation that we would not do that you would fully participate in all of the cash out refi and all of the sales. Let's say 20 or maybe 25 years from now, we have sold all of this real estate. Our hope is that as many people as possible that get into the fund right now are still there. Maybe it's their kids or even their grandkids, and they're fully participating that, and then the fund closes. I hope this doesn't add too much complexity, but I dream of this vision where this fund just runs for 200 years and all of our great grandchildren are getting cash flow from something they don't even know kind of where it came from. That's not going to happen because that's just not how an operating agreement for a business works. But as long as possible, if we did exercise the call option, it would be a minimum of 15% that you would get before we would be able to do that.
A minimum of 15% and 15 years. So kind of the most ridiculous terms our attorney was willing to sign off on.
Yep. All right. What else do we have? UBIT and retirement accounts. We talked about that. When you refi the owner finance part, won't that end up at a 90% LTV? So refinancing the Nicholas is going to be a bit of a maneuver. A lot of it is going to be really driving up the value through increasing the management on that building.
And we're just not in a hurry to refi that asset because we really don't want to repay a no interest, no payment loan for $9 million.
Yep. So that's, the benefit of the fund is the Nicholas can sit there for a little bit longer with that no interest, no payment loan, but we're able to have these other assets around it, lots of single family homes to speed up the velocity of capital there so that the aggregate return is that, 2 to 4 year period, 5 years at the worst that we're targeting. There's just such advantageous terms on the Nicholas as it stands. We talked about getting out of the fund. Is building ownership of Nicholas changing after the fund closes? Excellent question, very sophisticated question. Yes, absolutely. That was 100% part of our negotiations. It is going into Nicholas Real Estate LLC, which was 100% owned by the fund.
Yep.
Very important.
In terms of
Um,
forcing appreciation, can you give us a specific example of how management renovations on Nicholas you're making? Yeah, I mentioned rent escalations on tenants that have not seen a rent escalation in half a decade, building back utilities, just overall, rent escalations and optimizing management of the asset. The asset's in stellar condition. The owners have just loved on that asset. If anything, I'm worried that it's not going to be possible for us to love that asset as much as the current owners love that asset. But we do bring a level of sophistication that's really going to help us quite a bit. So if you go look online for information about the building, you're not really going to find anything. So it's old school management. You go door knock them to do a tour, or maybe find them on Google Maps after seeing it in person or getting a referral from another satisfied resident. Whereas we have a really aggressive marketing strategy that goes out to many different platforms. We own a Matterport camera and an aerial survey drone. So we know we're going to be able to really drive a lot of rent growth to the building, bringing all those tools and economies of scale to the management table.
I'm going to share a slide here that's similar. So this is the lofts right down the street from Nicholas, 2013 build, whereas Nicholas is 2015, built by the same builder. So this was one that's very similar to the Nicholas, right? We're not going to go in and do a major renovation on a 2013 build, or in the case of the Nicholas, a 2015 build. So part of it was negotiating really good debt terms. We did that on both deals. And then increasing the in-place rents. So on lofts, we've gone from about $1,200 per month to a little over $1,350 per month, mostly through marketing and through leasing. And I do want to point out that that's during the fall and winter in Minnesota, which it's just hard to describe how different that is than the spring and summer leasing season. That happens all over the country, but particularly in this very cold, snowy climate. So if we've been able to make this happen during a tough season, we're very confident that we're going to be able to make that happen with the Nicholas, and then just continue to do that over the years.
Yep.
So I would say the lofts is the most similar.
The pro forma is
acquisition.
almost identical. It's like very mild negative cash flow at closing, and then over the next year, we're going to escalate rents, carefully, not instigating huge vacancy or anything like that, and then it'll have rock solid performance. It's not going to be a big, deep value add kind of thing where we are able to refi out a year later, but we're putting such a small down payment on the property with such favorable debt terms that the yield, the rate of return is off the charts.
Our team is telling us that there's a lot of questions about bonus depreciation. So let's say you put in a $100,000 investment. How much depreciation can you anticipate in 2021? So the Nicholas is going to throw off an extraordinary amount of bonus depreciation because the down payment is so low. But a person with the IRS cannot have more depreciation than they have invested in the deal. So we anticipate that you would have a dollar for dollar depreciation. You can't go.
Well, it's going to be diluted because only 25% of the capital is going to Nicholas.
Yes. Yep.
So,
absolutely.
yeah.
That's important to mention. Excuse me. Sorry, I have a little bit of a cough. And then, but that any extra there carries over into future years.
So you'll get more depreciation in the future from acquisitions. We really hate to throw out a number here. There's so many variables here. We can tell you for sure it's going to be a very advantageous total amount of depreciation. Your 2021 depreciation is not going to be amazing compared to the amount of money you put in, because only $1 out of $4 in the fund is going into Nicholas. Essentially, if it was a normal loan, it would be like $1 out of $2 in the fund was going into Nicholas. So let's say if you put in 100K, you'd get at least 10K back in depreciation. I don't know. That's a really low, like way too conservative number, I guess. I almost regret saying that just now. It'll be more than that, but it's not going to be a huge amount in 2021. And then there will be a huge bolus of depreciation that you get in 2022, in addition to the depreciation from 2021. The fact that you can put in money today and still get a significant amount of depreciation this year is really exceptional.
Lots of questions showing up about real estate professional status. That's one that you really need to talk to your CPA or attorney about. Real estate professional status is such a hot topic. It's so highly litigated in the IRS code. some people would say that syndications and funds cannot be included in real estate professional status. Other very reputable, very knowledgeable CPAs would say that it can be, if as long as you have, your hours through your other active properties. We can't really comment on that. Either talk to your CPA or find a really good CPA. This is very much an art, but just know that there's really no clear-cut answer, and there's all sorts of knowledgeable, reputable, established CPAs all across the risk spectrum there.
I really like this question that Sanvi just asked in chat. Sorry to skip the line here. How soon do you think you're going to be able to deploy the funds? So we spoke to that just a little bit earlier. We're gonna take this fully funded private equity fund and go to every seller and broker we can find and say, hey, here's a proof of funds for $7.5 million. What do you have? And it would be our hope that we're able to find a really nice big asset that would really leverage the buying power of that fund. That may or may not happen, and it takes 6 months to take down some of these big deals. In the meantime, we'll be picking up single family homes or some other medium-sized multifamily properties. It would be our expectation we deploy these funds within the scope of 2022. I'm going to be blown away if we don't deploy those funds within the scope of 2022. Maybe it takes 9 or 10 months or something like that. I also think it's entirely possible we could send an email to the funds within the next month and say, hey, we found a $50 million asset, you want to put in a little bit more or something like that, so we can swing for the fences here. So it's we're very opportunistic in our acquisitions, so it's tough to predict, but certainly filling the fund is going to be our number one priority, second only to operations of our existing assets.
A question that's coming up a lot excuse me, is what opportunities might exist when we return capital. So our hope would be that at that time we have another fund that's operational. And of course you would have the opportunity to completely get your capital back and spend it on whatever you would like. But that we would have the opportunity that you could put that capital right into the next fund and then just continue this process. Kind of going back again to how Nick and I have created our own real estate portfolio. That's exactly how we've done that over and over.
If someone wants to get out of the fund, how does it affect the other members / investors, and what do they need to do, or what are the requirements to exit the funds? There's lots of ways that you could exit the fund. We've talked a little about the call option. It's shares in a company essentially, so you can sell it to anybody. So if you just wanted to sell it to a family member, you would need to put together a purchase agreement for the sale of those stocks. There's a first right of refusal for the existing membership group. So if you're going to sell it to Brother Bob for $10,000 a share,
and it would have to be an accredited investor.
That's right. Yep. And then this fund is only for accredited investors. I just realized we've not hammered on that. This fund is only for accredited investors. It's a oversight that we've not emphasized that enough. So if you're going to sell your shares to Brother Rob for $10,000 per share, the current membership needs to have the opportunity to buy at the same price and terms. If no one else wants to buy, then you sell the shares. We have no incentive for anyone to stay in the fund who doesn't want to stay in the fund. Simultaneously, with the way the fund is structured, you should never want to leave. And it's puzzling to us that people ask so much about leaving the fund. Like, it would be very financially and from a tax perspective very disadvantageous for you to ever exit the fund. You should have no money in it. It should be producing passive income, and then you have to write a big check to the IRS when you leave. So you shouldn't ever want to leave. But there's plenty of options that we've put into the fund to exit if you so choose.
One of the things that might be valuable is single family at scale, our course that we offer. It's a give what you can model, a $100 minimum, and all of that goes to charity. Nick and I don't collect any profit from that. 100% of the revenue goes to charity. So we actually pay for like the Kajabi and all of that just out of our own pockets because we believe so much in the charitable mission of that. But that really describes in painstaking detail over like 100 videos exactly our business model and how we do renovations, like what toilet do we use, what paint do we use, how do we find contractors, how do we do leasing showings, how does our management company run, and then this cash out refi thing, because it is very perplexing to us that people ask about leaving the fund when that's such a valuable part of the business plan is to stay in for as long as possible. And single family at scale really describes that. It might be a challenge for you to watch 100 videos in the next 24 hours. So schedule that one-on-one call with us and we'll kind of walk you through that again to really help you understand that and understand how valuable that is. But if you're interested in just kind of learning a great deal about our business model, single family at scale is the place to do that.
What's the difference between a hard and a soft commit? A soft commit is you saying that you're going to remit funds, and a hard commit is remitting those funds. So you can remit those funds right there in the portal via secure ACH.
Yeah, let's talk a little bit about that. So the Invest Next portal is secure ACH. We've worked hard to find a really secure portal so that we don't have to get into exchanging wire instructions and those sorts of things. We take wire fraud very, very seriously. And so we're just able to completely avoid that by having this secure portal to send in funds. Lots of folks have sent in funds already tonight. So it's pretty simple to get through the process there. And then I do just want to make sure I say again, because Nick, you're absolutely right. We didn't talk about that enough, that this is a 506C. So it's open to accredited investors only. In the portal, you can read the definition of an accredited investor. It's also in the operating agreement. There's income and net worth guidelines. There's a portal that you can use called Parallel Markets to verify your accredited investor status, or you can get a letter from your personal CPA or attorney. You do need to get that verification of accreditation status to us as quickly as possible. If we didn't receive verification of accredited investor status, we would need to return your funds and remove you from the fund. And if there's anyone that has already committed to the fund that isn't accredited, read the definition carefully, see if there's a way that you can qualify. If you definitely can't, let us know. Unfortunately, because of SEC regulations, we're not able to let you participate in this particular fund. We do have some plans for 2022 to have a different type of fund that the SEC does allow non-accredited investors, but because of the size of this fund and some other kind of things behind the scenes, we needed to make this accredited investors only. So that's pretty important. I'll make sure that's in our summary email as well, since we're getting to that so late. I do want to call out that several members of our team have been hanging with us very late, one of whom is on the East Coast, so it's closing in on midnight there. So Nick and I are going to keep going, answering some questions. We're committed to answering all of these questions, literally, if we're just doing it to the camera. So everyone can stay, and we're gonna keep answering questions. But I do want to make the offer to our very committed team members that if you would like to leave, by all means, get sleep. You guys are like total rock stars. Literally working all day and night for us.
We're having our team retreat that starts at 7:30 tomorrow morning downtown. So it's gonna be a short night.
Yeah. So thank you so much for coming. It's been very, very helpful for you guys to be here to compile these questions. Everybody give a little love in the chat.
We're gonna go
Riley
celebrate,
and Rebecca.
We're gonna go celebrate. It's very important to us that our staff owns the fund. So the staff is getting 5% of our portion of the fund.
And those of you that are here, don't tell anybody by morning, because that's our surprise announcement tomorrow.
Yeah.
So
we were talking to our attorneys trying to figure out the best way to structure that, and they're like, we've never had a client ask to give the funds to their employees or to give the funds to charity, so we don't know how to structure that. So it's just going to be a discretionary.
And let's be very clear that that's from our 50%.
Right.
That doesn't impact investors in any way. But that's really important to us, that a rising tide raises all boats.
That's right.
For the people that are working hard in this, and then just for the community at large as well.
And we want our staff, the people that are touching hands on the assets, to walk into the building and think, I own this. I not just spiritually, but like financially, I profit when this building does well, when these tenants are happy, when we take care of things, when we answer the phone. And we're all about alignment of interest. And if you want to know how someone really feels about something, ask them to put money on it. And so we put our money where our mouth is.
Yep, absolutely. So thank you guys. If you would like to leave, definitely feel free. I know it's been a very late night.
How does one commit? So you just go to the portal. You have an opportunity.
Sorry for my cough, you guys.
You just go to the portal. You have an opportunity to express interest in the form of a soft commit, a commitment to remit funds at some point in the future. Then you can go through the workflow to add your bank account to the portal and send an ACH payment. So you might need to get a couple micro deposits in your account to verify your account in the portal. Or if you have like Chase or Wells Fargo, one of the big banks, you just type in your login info, and it uses Plaid, a really secure ACH platform, to set you up. So many people are able to remit funds like right now. Usually it takes, days and exchanging wiring instructions and stuff to remit funds to a fund. In our case, we're using a really, really amazing platform that does all that inside the platform. And then that platform is then how you see how the investment is performing. So remittances back to you with returns go through the same account setup. You put in your tax ID. That's how you get your K1s. We can upload files. We can send you videos and emails, and it's all in one spot. So when you set up that account, that's it. You're done. You're going to be able to see everything from that one spot. And it takes, 1/10 of the amount of time and effort that's usually required to remit funds to a syndication or a fund or something like that. So it should be really straightforward. But if you do have any trouble, any technical problems with the platform, feel free to block a time with me, send us an email. I had 15 years in IT. I led 13 teams of engineers for the Mayo Clinic. So I think I can do a tech support call if your internet's not working or something like that.
Yeah, a couple of folks are saying they're having some troubles with maybe some like smaller banks, credit union. PNC is like a pretty big bank. I'm from Pittsburgh, Pennsylvania, so that warms my heart that you're banking with PNC.
Okay.
Schedule a call. I'll put the link here one more time.
And we can do like a Zoom call, a screen share, and if worst comes to worst, we can give you wiring instructions.
We would just do that verbally,
yeah.
and so that we can hear each other's voices. There's no potential for wire fraud. You know that you're getting the right number. But schedule a little call with Nick or I, and we'll walk you through that, or give wiring instructions if we need to. How full is the fund so far? How close are you to filling it?
So it's tough to say. We need to get into the portal to see what the different transaction statuses are right now. So I show 11.6 million in total soft commits and 6.7 million of people who have done the paperwork, because I can see the DocuSigns update in real time. Now I'm guessing some of those people have remitted funds already. So maybe like $1 million or something has been remitted already through ACH, but it takes a few days for the ACH to get there, especially for larger amounts. And I'm guessing some people need to move money around. And so it's tough to say, but I'm assuming if someone has signed the paperwork, like they're definitely remitting funds, but then it gets a little bit fuzzy in terms of funds being transferred. That's the advantage of the platform, is it can reconcile those things. I don't want to reconcile 100 different wire transfers with a spreadsheet somewhere.
Couple of different questions asking things like, what percentage do the capital partners get versus what percentage do we as the sponsors receive when properties are sold? How is there a 50-50 split among more than two investors? So kind of several questions kind of with a similar vein there. So 100% of capital that's through cash flow or capital events, so it's like a cash out refi, goes back to capital partners. That's all of you until all of your money is repaid back. And then after that, there's a 50-50 split. So Nick and I will have 50% of the fund, and the capital partners will have 50% of the fund. So I hope that kind of clarifies those couple of questions there. If that doesn't, schedule a call and we're happy to kind of walk through that. I would encourage you to think of it as, it's so simple that like the human mind tries to well, what about this or what about that? It's just really that simple. We're the kind of active boots on the ground partners. You all are the money partners. We're going to get all your money back, and then we're going to split everything 50-50 after that for as long as we can go. Let's try to get to 25 years. Probably is going to be more like 15 or 20.
Yep.
So hopefully that answers a lot of those questions. Does the fund offer any asset protection? Yep. Yes. So that is one of the kind of big benefits of a fund versus, say, like owning a single family home directly or participating in one of our joint ventures, is all of the capital partners are limited partners. So you have, I don't want to say zero, but pretty darn close to it, zero liability for anything that happens. If something were to happen to one of these assets, really the first line of liability would be the property management company, and then the insurance on the building, the umbrella insurance on top of everything. And then Nick and I, as signing the full recourse notes, the personal guarantee, that's kind of a different type of liability, but wanted to throw that in there. It would be very, very extraordinarily rare for limited partners in a fund to have any type of liability issues. I don't know if you want to comment on that.
we're extraordinarily well insured. So State Farm insures all of our buildings, which is very unusual. Most, syndicators or fund managers, they kind of go get the cheapest insurance policy they can get from any broker, any carrier. State Farm, if you are in the medical field or in the automotive industry or whatever, that they pay more and they pay faster than any other insurance company. So if there was some sort of liability incident, we're covered. We have an umbrella that a commercial and a personal umbrella that stack on top of that. And then our property management company, the most likely reason for a lawsuit would be like a housing discrimination case or something like that. So our property management company is really the group that has the largest amount of liability there, and our premiums reflect that. So there's just not a lot of opportunity for liability on the part of the capital partners for these deals.
What is the difference between a syndication and a private equity fund?
Love this question.
Yeah, that's a really good question. So a syndication is, let's all get together and put some money in a bucket, and we are going to go buy one thing. So we're going to go buy 123 Main Street, or we're going to go buy the Nicholas. And you definitively know that your money is going in to buy that one thing. A fund is, let's get together, let's put money in a bucket, and then we're going to go out and buy some things. And we put some kind of outer limits on there. We say kind of
we can't go buy cryptocurrency or something like that. That's illegal.
The sentence that you should have in your mind is long-term residential real estate in and around Rochester, Minnesota. So we're not going to buy luxury short-term rentals. We're not going to buy commercial buildings. We're not going to buy farmland. We're not going to buy cryptocurrency. We're not going to go open a lemonade stand. We're going to buy long-term residential real estate in and around Rochester, Minnesota. We know that we're going to buy the Nicholas and Oliver. We have a closing date set for those.
We're relatively certain.
We're under contract.
Yeah.
Everything else we don't know. So we showed the map of some of the things that we're targeting. We're in negotiations with those sellers. We've showed like single family homes. Most of our single family homes we acquire from the MLS. So we're just monitoring the MLS every single day, and whatever opportunities come up that look like a good opportunity, we'll use the dollars in this fund to purchase that real estate. But that's the main difference. You can kind of think of it as like a 1-to-1 ratio between a bucket of money and a property is a syndication. A 1-to-many ratio of one bucket of money to many properties is a fund. The downsides of a fund are you don't definitively know how we're going to spend that money. Again, we have those parameters there, that one sentence, long-term residential real estate in and around Rochester, Minnesota. And you have our track record. But you don't know exactly we don't know exactly what we're going to buy. The upside is kind of when we were giving that example of like the furnace goes out or that sort of thing, you're protected because you're invested in all of those different properties. So if you have, let's say we have 30 single family homes in the property and one of them needs a new furnace. Well, if that's 30 different individual owners, if you're number 30, you don't care that people 1 through 29 didn't have to replace a furnace that year. You only care that you had to replace a furnace that year. In the fund, you have ownership in all 30 of those homes. We really love the idea of a fund. We basically raced to a fund, kind of a fund, as quickly as we could in our own personal portfolio. When we had like 4 or 5 single family homes, we realized we need to get as many of these as we possibly can, so that when we get the call, hey, house on Sesame Street needs a furnace, no big deal. We own 50, 80 single family homes. It'll happen. And so we're taking that same ownership model from our single family home portfolio that we've been doing for 10 years and putting it into this fund structure. But that's an excellent question. I also want to call out that a couple different people have said like, sorry for the simple question, or sorry, I'm a newbie. There are no apologies here. We love teaching. We love serving. Why would we hang out until 11 o'clock at night if we didn't? Everyone has questions. We have questions still. We're going to our attorneys and asking questions. We're here to teach. We're here to serve. We're here to grow together. There are no silly questions, no simple questions. So just wanted to call out that as well.
Absolutely. And one thing I want to touch on with the fund is it's difficult to overstate how big of an advantage this gives us in the marketplace. So there was a deal that transacted here earlier this year. It was a portfolio of properties that transacted for about $55 million in total. We wrote an offer on that deal. We put together a joint venture partnership for it. That joint venture partnership had insane liquidity and net worth and everything. But the conversation with the broker goes like this, like, okay, so are you a fund? No. Okay. Are you sure you want to look at the buildings? Like that's literally how the conversation goes. And we wanted some of the buildings, but not other buildings. They had kind of a mixed profile of some Class B properties, some Class C properties, some Class D properties. We would have loved to buy the whole portfolio because you had to buy them all, and then like sell off the Class D properties, but then keep the Class B properties, and maybe we could renovate up a couple of the Class C properties to Class B or something like that. All those things are completely possible within a fund, and really kind of easy to do because you have the liquidity and the eligibility for debt, and just the credibility with the seller to make all those things happen. That what we could have made $10 million for a fund if we had a fund at that point in time to do that deal, because we didn't have a fund. Like we wrote an offer and they humored us. We were within like 1% of purchase price on the assets, in the deal, but our offer was never really taken seriously because we weren't a fund. So we're just at a point here where we really kind of have to have a fund in order to even be considered on some of these deals.
What is the currency vacancy rate at the Nicholas? The Nicholas is essentially 100% full. I think it's like 99% full right this very instant.
Yeah, the Nicholas is really one of the only urban core buildings that didn't struggle with massive vacancy during the COVID pandemic. Part of that's because they do have low rents. So they were just, people were less willing to leave a property if they know that the rent is low. And then just stellar management, just their management cares. They got a group of nuns recruited to live there. Like that's a really sacred kind of caste of individual in Rochester. Nuns founded the Mayo Clinic, and to have a nun live in your apartment building is quite a distinction. And they have 3 nuns that live in their apartment building. People don't leave those communities. So extraordinarily low vacancy in this asset.
Couple of good questions about the reason for the investment minimum of 100,000. So a $10 million fund is a kind of a larger capital raise. And we really wanted to make sure we kept our partnership group under 100 people. So it was literally just 10 million divided by 100 comes to a $100,000 minimum. People have asked, can we make modifications or special exceptions? We're really not able to, because the operating agreement very clearly says that it's a $100,000 minimum. So if we have 40 people that sign that operating agreement, and then we allow the 41st person to come in at a lower minimum, we would be violating our own operating agreement. So that's the reason for that. We do anticipate that we will have some opportunities in 2022, potentially with a lower minimum. That's something that's very near and dear to our hearts. We've built single family at scale. We've done private lending partnerships, some other things that have no minimums, teaching people how to invest, having our course out there for $100 minimum, give what you can, so that many people have access to real estate investments, even if you don't have $100,000 or more. With this particular operating agreement, we weren't able to make that happen. We actually see us moving in that right direction, though. So with our joint ventures, those by definition have to be a small group of people. So many of our joint ventures are us and just one other person, or a married couple, or maybe 3 other families, or those sorts of things. And so we had to work with investors that have 500,000 or $1 million. And we love working with those folks. We're excited about that. But we also want to be able to work with folks that have smaller amounts of capital. So we've structured this fund so that we don't have to say no. If you've listened to the webinar, you've decided that you want to participate, but we have to take this one investor at $1 million. So we hear that, we take that very seriously. Thank you for letting us know. That tells us that there's interest at these lower amounts.
We might do like a $5 million fund with a 506B that could accept non-accredited investors or something like that. So we probably wouldn't go do like a Nicholas size deal with that smaller fund, but it would be open to people with smaller investment amounts. And this is something we're going to calibrate over time. Our goal eventually is to do, like a $100 million fund. That's our big goal there. But there's going to be lots of opportunity along the way.
Excuse me. Sorry about my cough, guys. I'm so sorry. With a cash out refinance, doesn't that reduce cash flow? That's a question that's been asked multiple times. Yes, you're absolutely right. So as the value of the asset goes up, you're collecting rents and getting cash flow there. And then when you do a cash out refinance event, well, then the mortgage goes up, right? So then the mortgage payment goes up. So then cash flow goes down. So there is a bit of a, hopefully my finger kind of shows, there is a bit of a kind of up and down. I don't want to say a roller coaster because you know that it's coming. So the trade-off there is you get a big lump sum of liquidity all in one check in exchange for future, slightly lower cash flow. And then the way that smooths back out is then rent, continues to escalate over years, just with normal, market rental increases. And so then cash flow goes back up. And then the value of the asset continues to go up. And then there's a cash out refi, big injection of liquidity, and then cash flow goes down. So there's a bit of a kind of a wave, we'll call it there. But you're absolutely right that when there's a cash out refi event, the trade-off there is that it reduces cash flow. It's a tax-free big check that you'll get. So I think most people will be very excited about slightly reducing their cash flow in exchange for getting a large lump sum of tax-free dollars. People have asked about, well, how is a cash out refi a tax-free event? That's just how the IRS sets it up. So it's not income per se, right? So
it's backed by
it's backed by debt.
Yeah.
Yeah.
So you have debt that shows up on your K1 that offsets your cash income. So you're not realizing a profit.
Yep. And we think that's, so powerful, because if you can keep 100% of your money and use it and spend it and do what you want to do with it further and further and further into the future and minimize, the tax that you need to pay, well, then you're able to grow way faster and reinvest, spend that, do whatever you need to do. And then the value of the property continues to go up.
Yep. And in general, equity is what makes you wealthy. So debt pay down and appreciation. Cash flow just is not in the long run your biggest wealth driver. Your equity typically dwarfs your cash flow by a ratio of 3 or 4 to 1. So we did a refi a couple of years ago on a good chunk of our portfolio. We got a 7-figure check at closing. The size of that check exceeded all of the cash flow that we made on our entire portfolio ever combined. And that's not an unusual thing. People make a big deal about cash flow. We want to make sure we're cash flow positive, but really cash flow does not make you rich. We want to do everything we can to maximize equity and maximizing your leverage, as long as you're doing it safely.
And again, none of you are signing on that leverage.
That's right.
That's us and the fund. I want to be very clear about that.
Yeah.
But
so maximizing your leverage tends to maximize your total annualized rate of return. If you have favorable debt, and we tend to get exceptionally favorable debt against assets that are appreciating, that's a recipe for extraordinary wealth.
I want to answer these really important legal questions. How is asset ownership legally distributed under the fund structure? Would the fund be the legal entity that owns the asset? Is there a guarantee in the contract language that makes sure that investors participate in any upside appreciation in the future? All very good questions. So let's go through those slowly. So
if you put
thank
$1 million,
you. Sorry.
Yeah, if you put $1 million into the fund, you own 5% of the entire fund. That's it. There's no complicated math or anything like that. So the question there, do they own an actual percentage of the asset? Yeah. So you would own 5% Nicholas, 5% of Oliver, that sort of thing. How would asset ownership be legally distributed under the fund structure? You own 5%. That's it.
There are two places in the operating agreement that say all cash flow goes to investors until 100% of unrecovered capital is paid back. And then there's a 50-50 split after that. And then right below that is the thing that says all capital events, i.e. a cash out refinance or a sale, goes 100% to capital partners until they're completely repaid back, and then a 50-50 split after that. So that's very clearly delineated right there in the operating agreement. Would the fund be the legal entity that owns the asset? No. So like, for example, the Nicholas will be owned by Nicholas Real Estate LLC. That is 100% owned by the fund. And the reason for that is the fund is going to own somewhere around 50 to, let's say, 65 million in real estate assets, depending on how much we're able to purchase. And we would not want one LLC to own all of that. So the fund will own several LLCs that own different pieces of real estate. How that will likely shake itself out is the fund will own Nicholas, the fund will own a couple of different apartment buildings, and then the fund will own an LLC that owns like a portfolio of single family homes. but that's simply for asset protection, for liability, for like accounting reasons. There's no other additional owners or splits or anything like that. That's just to protect it so that we don't have one LLC that's, you know, over $50 million in real estate assets.
Is there a guarantee in the contract language which makes sure investors don't participate in any upside appreciation in the future? So I think this question is really driven by the way most syndications are structured. It almost sounds like a silly question in the context of our structure. Like you get all the money until you get your money back, and then it's a 50-50 split after that. But the way most syndications work is, for example, you buy the asset, there's like a fee that goes to the general partner, then there's a split on cash flow, and that cash flow is kind of treated differently than proceeds from a sale, is treated differently than sales of a refi. And maybe there's like an 80-20 split on cash flow until the partner's gotten their money back. And then it's a 50-50 split on cash flow, or there's a waterfall where if certain performance benchmarks are hit, it's a 80-20 split, then a 60-40 split, then a 60-40 split in the other direction. And then at the time of sale or a time of refi, there's a fee that's collected for the general partner. And then that capital is kind of handled differently on different splits or whatever than cash flow. It's really, frankly, quite confusing. And there's reasons for, there's good reasons why that's the typical structure to try to incentivize certain outcomes. But the end outcome is really hard to understand how much money you actually make at the deal. So we try to make our deal hopelessly simple, hopelessly easy to understand. So there's not really like a need for a specific handling of how allocations are made from future, you know, upside potential from a refi or a sale, because it's all handled the same.
How does transparency work with the fund with distributions and profits? So in the operating agreement, it describes that we have to share financial statements every quarter, and then your distributions have to come 45 days after that. We use the real estate CPA. One of the partners is the CFO of our company. So they'll prepare all of those statements. And then of course, they'll also prepare the K1s, and you'll see those. So you'll see, you know, actual income, actual expenses, and then how that's distributed out every quarter.
And if you are in the portal, like that's how you're going to get all that information.
Yep.
So you're already signed up to receive all that information. And we love to communicate with our partners. So we'll send out videos or little updates of, hey, we, you know, filled the last unit, you know, at this building or something like that.
Yeah. Some folks asked about having questions about the section on documentation as an accredited investor. So Nick, I'd like for you to speak to Parallel Markets, because we raced to try to get onboarded with them. So you can go through Parallel Markets, which is free for you. We shoulder that cost and submit that form. Or you can have a personal CPA or a personal attorney fill out the form and then submit that to us. Or if you have a form from a different syndication or fund or something you've participated in, if that verification of your accreditation or your accredited investor status is recent enough, you can submit that. So there's lots of different ways there. It is very important that you believe wholeheartedly that you are an accredited investor to invest, because you do have to submit that paperwork in a timely fashion. That's like the least time sensitive thing though. So schedule a call with us. You know, we'll talk you through.
You can send funds before we validate that you're an accredited investor. It's also worth mentioning that if you have hit the income threshold, but not the net worth threshold, so you need to have an income for this year, the previous year, or I'm sorry, for the last 2 years, and a reasonable expectation for the current year. So as of January 1st, you might be eligible, and right now you may not be. That's okay. That's within an acceptable time horizon. Ultimately, we cannot like coach you on the preparation of those forms or help you prepare those forms. That would be a conflict of interest, obviously. Your CPA has to help you with that. Your attorney can help you with that. Verify investor, Parallel Markets. I mean, we're going to do everything we can to serve you to make sure you're able to prepare those. And we're legally required to make, you know, all best efforts to obtain that verification from you that you are an accredited investor from, you know, verified by an accountant or an attorney or one of these other services that perform these verifications.
What other questions do we have? What is our property management fee? We charge 10% of gross rents collected. That's it. We have had some other fees, like a leasing commission and some other fees in our third-party property management. And we've made the decision to further align incentives to just remove all of those fees. It aligns our incentives that our property management company will only collect revenue when the assets are collecting revenue. If there's a vacancy, we don't collect on that. If rents go down, we lower our collections there. And then it also just really simplifies things from an accounting perspective, which we're really excited about.
Which is a very, very unusual model in the property management industry. Most property management companies collect about 30% of their revenue and almost all their profit from ancillary fees. So from quarterly inspection fees or winterization fees, any kind of site visit potentially instigates charges back to the property owner. We don't do any of that. We're very deliberate in passing, basically any revenue we collect back to the owner, making sure that we're collecting revenue in a really transparent way. And then again, almost all property management companies in the multifamily space, they have fixed costs that they bill back to the asset, like salaries, payroll, benefits, transportation charges, legal expenses, costs for their property management software, which can really disalign incentives because there's just not enough incentive there to make the asset perform. So that's a very big difference from a typical property management model.
Let's see here. There's a question, a really good question from Andrew about closing the fund. Let's say we close the fund in 15 years. Won't there be a big tax event at that point? So the refi distributions are tax-free, but should we be thinking of them as tax deferred? Yes, absolutely. They're tax deferred. When the fund closes, which it eventually will, there will be depreciation recapture at that point. That's absolutely true. It's very, very, very important that be understood. You are thinking about it correctly. Our plan here, our hope would be that we're able to time the closing of the fund with a very advantageous sale. So there's profit that comes in at the same time that the fund closes. So you hopefully get a nice big check, and then you are going to have some portion of that check is going to go to depreciation recapture. Everyone's going to have a different tax situation, but depreciation recapture is a thing that we all need to be thinking about. Our goal here with the fund is to push that as long as possible. So instead of, I'm going to invest in this syndication, then I need to think about depreciation recapture in 3 years or 5 years, and then do that over and over and over again to push that can down the road as far as possible. Our hope is that everyone that invests in this fund is with us on earth when we close the fund. It's likely that some people won't be, and depreciation is one of the things that goes away in the event of a taxpayer's death. And that, and then, like I said, that we can time that with an advantageous sale. So not only would we not want to sell assets, say during a downturn, because that's not a savvy thing to do from a business perspective, but then that wouldn't give that big check of equity that can be used to offset the tax that's going to come at the time that the fund closes.
And we're very focused on the long term here. So other syndication stuff we've talked to, and our attorney have said, why the heck are you doing a no fee fund? Like, how are you making money at this? Well, first of all, we're making plenty of money at this. We don't have any need or desire to make more. In fact, we're giving away a bunch of our money to our employees and our charity, but we're focused on the long term here. We want this to be like a hopeless no-brainer for people. And then whenever at some point in the future this fund does wind up, we will probably have the $100 million fund option available for you to roll into. And there will be huge depreciation advantages from participating in that fund that will probably offset the depreciation recapture from this fund. So I don't know when that $100 million fund will exist. Based on how this webinar has gone so far, it seems like maybe sooner than I expected, but that's our goal. We're really focused on that long term. Who cares about a few fees on a $10 million fund? I want to own half of a $100 million fund. I want to change capitalism. So that's kind of our perspective there. And we can't promise you that there will be some, opportunity to offset your recapture liability when this fund does eventually sell. But we'd kind of be stupid not to give you some kind of buy it now button when you get a big check from this fund, right? You'd be really excited that you got the big check. You're not sure what to do with it. We're gonna make sure there's something for you to do with that money.
A technical question, can we invest in a personal name, then change to a living trust? So yes, that's an artifact of us, racing as quickly as we could to get our investor portal set up. So we only set up the individual or spouse pipeline. There are also
And the retirement
account. Yeah. The two that would be the most frequently used tonight. But there are ways to invest in a trust or an entity. If that applies to you, send me an email. That would be a good reason to block one of those 20-minute calls, just to make sure we have a dedicated time to go through carefully and make sure that we've moved your personal investment over to your trust. That would be a time that I would ask that you not remit funds, so that we can essentially cancel your personal name paperwork and then put it in the trust, and then you would submit funds directly there, just to make sure it's completely on the up and up from an accounting and legal perspective. But we have had a few questions about that. Make sure you understand the accreditation requirements for a trust. They are a little bit stricter than the accreditation requirements for an individual, but if your trust is accredited, we're happy to make that happen for people. So just schedule a call with us.
Other funds provide a linked verification service for investors. Why do you not have that? Excellent question. I would like to ask Parallel Markets why that is true also. We have tried to onboard with Parallel Markets and Verify Investor, and that has been a slower process than we would like. Keep in mind, this fund was born 7 days ago. I
think it was like 10.
We'd already talked to the attorney and different people, and we had a bunch of things kind of set up. And then Nicholas and Oliver came, and we were like, yep, this is it. So we had to move very quickly, and some of these services onboard slower than we'd like. Another interesting thing is Invest Next, in its next release, probably the next month or two, will have a direct integration with Parallel Markets. So Parallel Markets is like, hey, why don't you just hold off on onboarding, because we're already setting this up for everybody on Invest Next. So I think we kind of got put on the back burner or something. They haven't been responding to our emails. Great company. Just they're like, hey, just wait. And we're like, no, we're raising like $10 million tomorrow. We really need onboard. And that's why that has not happened. So you can get a letter from your accountant, letter from your attorney. You can work with Parallel Markets or with Verify Investor. And if we are able to onboard with those services in the next few days or weeks or months, if people haven't verified or whatever, we'll send out those links.
Yep, absolutely.
Yep.
And there is a way through Parallel Markets that you as an individual don't have to pay for that. So it shouldn't cost you anything to get your verification. Some people have asked about, can I 1031 into the fund, or can I 1031 out of the fund? Again, that's a question really for your personal CPA or personal attorney. In general, no. In general, you can think about kind of these group investments that you can't 1031 in and out. But that's really your own tax decision. So if your personal CPA was okay with it, that would be your personal decision to do so.
What's the difference between Fund 1 and Fund 2? Well, Fund 1 has existed for a week or two now. Fund 2 has existed for several hours, we'll say, from a spiritual perspective, based on how Fund 1 is going so far. So Fund 1 is a carbon copy of the exact same deal structure we've been using for a very long time. We love just, you get all the profit until you get your money back, and then 50-50 split after that. Almost all of our JV deals are done with that structure. We were doing single family deals with that structure a long time ago. I don't expect that structure is really going to change at all in Fund 2 or Fund 3 or Fund 4. It might. I mean, we might learn some lessons or whatever from Fund 1 that we want to change some things, but it's entirely likely that future funds will be a carbon copy of the current fund.
One question that keeps coming up that people want to talk about is managing risk around the cash out refis, particularly that, the plan is to have multiple cash out refis. So like using one of the single family homes that we have in our portfolio as an example, we purchased it many, many years ago. This was in Oklahoma City, so the numbers are a little bit different in Rochester, but we purchased it for $35,000. We put $15,000 in, so we were about $50,000 of capital into that. At the time that the renovations were complete, it was worth about $85,000. We did a cash out refi at an 80% LTV, so we were able to completely repay back ourselves all of capital. Actually, have a few thousand more dollars in our bank account, and then it was a cash flowing rental. And then today, it's worth probably, I don't know, what would you say, maybe 140,000, 130,000?
We'll say 120 minimum.
Yeah. refining that again, it does increase the risk there. So managing that is, constantly looking at where values are going, where values have been, deciding, is it a good time to refi? There are obviously major benefits to getting that big liquidity injection. But if it looks like the market's rocky or things aren't going to go so well, then, we may kind of hold steady and not do a cash out refi and just continue to enjoy the cash flow. If, let's say, we did get into a situation where the value of the assets was not enough to cover all of the debt, which I don't think is likely, but can happen, right? Market crashes have happened, market dips have and do happen, then we would just hold through that. And that's one of the benefits is, I think in our minds, we think of this as an indefinite fund. We're in our 30s. If we were closing this fund when we were in our 90s, that would tickle us pink. If our children were running this fund and your children were all, or nieces or nephews, or whoever is important to you, were benefiting from the fund, that would tickle us pink. But let's say we get to a 20-year time frame and, kind of everyone's ready to sort of wrap this thing up and values aren't looking so hot. Well, we're going to say, hey guys, we need to hold another 10 years. We need to wait for values to go back up. As long as everything's cash flowing and, you've received all of your initial capital a decade and a half ago, we're not going to make an ill decision to end the fund at a time when it doesn't make sense in the market cycle.
Yep.
So the main protection is getting all of your capital back as quickly as possible and then just enjoying the ride after that.
And a word about the idea that high leverage is high risk. That's true. Like intuitively, that's true. If you really want to think about it from maybe a little bit more sophisticated perspective, we buy a lot of distressed real estate. So we see what it looks like when things don't go so well from the other side of the table. And the first thing the bank does is they offer you a deed in lieu of foreclosure. So basically, if you have an operating residential real estate property, an apartment building, the bank never, ever, ever forecloses on that because so much value can be lost in that process.
I don't think the SEC wants you to say never, but
it's
extraordinarily rare.
I have yet.
We have never seen it.
I have asked everybody in real estate I've ever met, have you ever heard of an apartment building being foreclosed on that was being operated, in the realm of reasonable? I have never found that to be the case. Now they will foreclose on like farmland and stuff where there's not a potential risk of loss from going through that foreclosure process. But if you're running an apartment building and someone forecloses on it, a bank forecloses on it, you could stop collecting rents, stop responding to maintenance tickets, vacate tenants, and all of a sudden millions of dollars of value can be lost. So you have a little bit of a game of chicken there with the lender. And we've seen things on the other side of the equation, and the bank will offer a deed in lieu of foreclosure, and they'll approach us and say, hey, Stoggebergs, we've got this apartment building that's really struggling. Could you buy it from the owner? Because we really don't want to foreclose on it. And we offered a deed in lieu of foreclosure, and they turned it down. Here's how much they owe. Here's their contact info. We can get you a warm introduction. Would you please buy it from them? This is how badly banks don't want to foreclose on assets. In that situation, leverage is your number one defense. Because if you had like a 50% LTV loan, the calculus from that lender is a little bit different, right? Because if the asset lost some of its value, they're still covered. Whereas if you had like an 80% LTV loan, if it lost even just a little bit of value, you are not covered. So even if you stopped making your mortgage payments altogether, you are potentially in a better defensive posture with more leverage. Now, we don't plan on any of these things happening, right? But we've seen them happen on the flip side of the equation when we go acquire distressed real estate. So we know how this story goes. And it turns out that leverage is actually a really powerful defensive mechanism if things do go horribly awry. Same thing is the case with liability. Let's say there's a terrible liability event. Every single tenant at the same moment has a slip and fall on the asset. If you have lazy equity in the asset and low leverage, you could lose that equity. If there's a lot of leverage on that asset, it's very likely you won't even be sued because the attorneys know there's not enough equity to go after. I don't want to get too deep into the rabbit hole, but this is something that we spent a great deal of time researching, talking to bankers, talking to attorneys, trying to figure out what is an optimal amount of leverage to have. And time and time again, our conclusion is that the more leverage you have on the asset, the better, as long as you're able to stay cash flow positive, that leverage protects you in almost every single downside event.
a question about, looks like you will only cash out refi on 75% of individual investment amount by year 5, since 25% will be invested in Nicholas. Do you still think you will be able to return the capital back with that?
Yeah, so a quarter of the capital in the fund is going to Nicholas. Nicholas has this really advantageous debt that we don't particularly want to refi out of. And then 75% of the capital in the fund is going to go into assets that potentially could refi sooner. So the question is, is it possible for you to return capital in that time frame, knowing that a bunch of capital is going to an asset that won't necessarily refi anytime soon? Now, from an SEC perspective, we're getting dangerously into the territory of giving you a pro forma. You've seen how in our historical performance, and again, historical performance is not necessarily indicative of future outcomes, but you've seen how we're able to sometimes return capital very quickly. And then that asset's going to be, cash flowing thereafter. Nicholas will be cash flowing, so you'll get a return of capital from cash flow as well. So even if there is a bucket of lazy equity in Nicholas, we're still going to be able to return a great deal of capital. And let me be very clear that we're not necessarily promising you'll get a 100% of return of capital by any particular time frame. There will be some big refi events that occur where you'll get potentially all of your capital back, potentially some of your capital back, probably most of your capital back. So let's say you have 10% of your capital left in the deal at the end of year 4. You're still pretty darn happy with your overall rate of return there. You're still getting an exceptional rate of return. And that last 10% is going to come really quick from cash flow thereafter.
Yep. Very, very good question.
Yeah, excellent question.
And then a question that's repeatedly coming up is about appreciation of single family homes in Rochester. So in all of our pro formas that we write for ourselves, and when we were doing third-party property management for our potential investors, we pencil in a 4% appreciation. And the reason for that is when the National Association of Realtors looks at real estate trends over the last century, it comes out to about a 4.4% appreciation per year
in urban areas.
Yep, in non-rural areas. So that, Rochester is a non-rural area. So that's where we come up with that number, is over a long time frame across the whole country, really most real estate. And in Rochester, we have beat that number time and time again. So earlier in our investment career, it was more like a 5 or 6% appreciation, which is a big bump into itself. Over the last several years, it's been 10% year over year. For the last year, it's been like 12 or 13%. Again, past performance of what we do and what the market does is not indicative of future outcomes. It looks like appreciation is going to continue to be very, very healthy because of the housing crisis that we're in, because there are many more people that need a place to live than there are places to live. That's happening in the whole country. That's because of 2008, when many builders went out of business and never came back into business. The smallest number of homes have been built in the United States in the last decade than any other decade in the 20th century. So obviously the population's bigger today than it was in, say, 1950, but from 1950 to 1960, more homes were built than between 2008 or 2010 and 2020.
That's an important thing to understand. More homes were built between 1950 and 1960 than were built between 2010 and 2020. That's crazy. So
all of that leads to just basic law of supply and demand. So we anticipate that prices will continue to go up, and we anticipate that it would be higher than the 4% that we write into our pro forma. We try to be very conservative in our underwriting. One of the things that we really like about Rochester is that not only does it enjoy benefiting from the national trends and this housing crisis and stuff that we've talked about, but from the destination medical center and the population growing and the number of very good jobs growing. So we love single family homes. They are more dependent on market appreciation than a multifamily property, because a multifamily property is valued more as a business based on the net operating income. But we're very excited about continuing to invest in Rochester single family homes, and anticipate, based on our personal projections, that appreciation should be close to double digit or higher than double digit maybe for the next year or two. We'll probably start to be a little more moderate after that. again, who knows? No one has a crystal ball. Those are the things that get us excited about investing in single family homes.
I like how specific this question is from Mystery Reader. I just want to make sure I understand this right. If I invest 100K and after 5 years, I get that 100K back. After that, I still have a 100K ownership stake in the fund that if I want to, I can sell to someone else to get out of the fund. So that's close. I would refine that just a tiny bit. I would say that you'll get all your money back. And then after you've gotten your money back, you still have your ownership stake in the fund that you could sell to someone else. That's exactly right. Now, that's not to say that your ownership stake is worth 100K. That is the face value of the share value today. I hope it's worth more 5 years from now. Certainly, it could be worth 50K. It could be worth 200K. And we cannot promise a particular kind of return. That's an SEC situation there. I think guessing that it might be worth 100K is a pretty good guess, but it's not necessarily symmetric or fixed or anything like that. So if you put $1 million in the fund today, you'd own 5% of the fund today. And 5 years from now, after you've gotten all your money back, you'd still own 5% of the fund.
Very good. Well, I have gone through the 7 pages of questions that you all submitted in chat, and Riley and Rebecca have done an amazing job of kind of compiling them together, bolding the ones that are pretty common, and then we've crossed them off as we've gone. I believe that we've answered everything here, and we're getting close to midnight even in Central Time Zone. Y'all on the West Coast are like, hey, the party is just getting started. And the East Coast, everyone's probably in bed or hopefully in bed.
I hope so.
So I think we'll probably wrap up there.
Sounds wise. We got to stop sometime.
Yeah, we got to stop sometime. I hope this has been really valuable. I hope that it's fun. I hope that you enjoy, thinking about your own future and investment opportunities that are out there, whether that's with us or if you're just learning a lot to invest elsewhere. We're happy with that too. We hope that you see how differently we think about things and how excited we are about improving people's lives, improving communities, improving property management, and even changing the way like private equity is done. Tonight has been a runaway success. We're well over 12 million in commits. Nick just kind of closed the number, but I think we're close to 8 million of
paperwork
hard committed.
Well, yeah, we need to refine that, but paperwork done.
Yep. So if you're interested in the fund, let us know right away through the portal, through moving through the paperwork process, scheduling a meeting with us. I'll put those in chat just one more time here. So that's kind of the last thing you guys see. And we are super excited. I mean it when I say I'll end on the emotional note here, the feminine note. I've spent a lot of the day.
I'm tearing up over here too.
I've spent a lot of the day and just with tears in my eyes, and my kids are like, Mama, why are you crying? Are you sad? And I'm like, no, I'm just really humbled and honored that so many people would invest with us and believe in us. And we take it so seriously that, these are your funds that you worked hard for, that are fueling your passive income so that you can make a change in your life, or, take some time off or cut back or prepare for your retirement. And just how exciting it is that we get to partner with all of you. Lots of folks we've been working with for a long time. Lots of folks here are new tonight too. We're excited about many of the new relationships that we're going to start. Lots of people are scheduling those 20-minute calls just to get to know us better, just to have a one-on-one call, particularly folks that we haven't worked with before. A couple of people have said, like, is that okay? Absolutely. That's what keeps it fun for us, is to know, when we have to take a water main call at midnight, we're thinking about who are we working for? Who are the investors? Obviously we can see our tenants, we know them face to face, but who are the investors that we're working for? That's what keeps it really interesting for us. That you all have hung with us for so long. It means a great deal to us. We know that every hour in your week is so valuable. It's an hour that you're not with your hobbies or your family or your children or whatever else is important to you. So thank you so much for that. It's a night we won't soon forget. So thank you.
Thank you. Good night.